Hello. Hey everybody, welcome to my channel. So I'm going to talk about two things today: interest rates and the stock Fastly. I've been working on this video for interest rates. I keep hitting roadblocks, so I figured I'll just do a live stream. Maybe I'll get some ideas to maybe add more content to it. Let me know in the comments if you're here, because it doesn't look like anybody's there. Okay, here it is. It uploaded. So interest rates are really important to understand because the market is very dependent on rates. And I'll go through these slides, and I think it'll provide more color on why interest rates kind of move the market in one direction or another. So I'll start with high level, possibly some boring stuff. It's only 6-7 slides, and then we'll talk about Fastly after this. So the Fed funds rate, that's probably the rate people are more familiar with. Hey, Matthew from Amherst. I went to school in Amherst, New York, Buffalo. So the Fed funds rate is the key tool for the federal government to control the economy. And I think of the U.S. economy or any government in any country like a business. It acts in a similar way, slightly different, but it's the same kind of idea. They want to be profitable. They don't want to lose money. Now, the country, like the U.S. government, doesn't need to make a lot of money. They just need to cover their expenses and not go into too much debt. So they have many employees. They have teachers, firemen, policemen, people at the Federal Reserve, and the way they pay these employees are with your taxes. So, but the Fed funds rate, they throughout the year, they either increase or decrease the rate. And hey, Chris, what's up? Yeah, I enjoy doing these live streams. Kind of like pitching ideas to you guys, and it's a good kind of back and forth. But as I go through the slides, I think you'll understand what rates are, how they're figured out, and how they affect the market. It is hard to invest in stocks based on the movement of rates, which stocks to invest in. That's a little deeper, and we could talk about that, but let's just keep moving forward and just ask questions, because I'm learning too. We're all learning together, so ask questions, and hopefully I know the answer. If I don't, I'll just figure it out on this stream with you. So when the impact of rates, as I'm sure you're aware of, impacts many things. The interest rate in your savings account, the rate you pay on credit cards, all loans. I mean, the list goes on and on. It has a huge trickle-down effect. So why does the Fed lower interest rates? Well, the main reason is to stimulate the economy by adding money. And how does lower interest rates add money? Well, when rates are low, people are much more likely to take on a loan. And when the Fed lowers their target rate, then banks also pay a lower rate, because the Fed rate is the rate banks lend to each other. The discount rate is the rate the Fed lends to banks, but the Fed rate is the rate banks lend to each other. So low interest rate loans are, of course, more appealing because if you want to buy a home, a lot of people can't even afford the monthly payment, so they're still renting, or they can't afford the down payment. But if rates come down to a low level like they did a few years ago, I got a loan at 3%, which is crazy. Then it's so much more affordable because that could drastically lower your monthly payments. Home prices generally go up with lower rates. So hopefully the price of the home doesn't go up too much where it doesn't even benefit you. But the idea is you'll be able to fund things like buying a home, buying a business, or maybe even just fixing up your current home and maybe going on vacation. You take a personal loan because rates are lower, like 5, 6, 7, 8%. Personal loans generally have higher rates because there's nothing backing the loan, so it could be usually in the double digits. So it has a positive impact on the economy. It increases the flow of money in the economy. More people are borrowing money. Hey, Derek, what's up? Which means more people are spending. They're going on vacation. They're buying nicer things. Those businesses now have more money, so they're able to invest in growing their business, maybe getting more employees, employing more people. It's a huge trickle-down effect. So it's like, why would the Fed ever raise interest rates? Like, what's the point if it's a growing economy? Just keep growing. Well, we don't want to be like Venezuela, where inflation gets too crazy high, because people do take advantage. When rates get too low, people will take advantage, and there's things called bubbles, and then people just start overspending. The market goes up and up and up and up because people think, oh, it's never going to stop. So they just keep levering up and taking on debt. And then there's a big bubble. A lot of people go bankrupt. So the U.S. government, like any government, tries to control rates, tries to control the economy so things don't get too out of hand. They want to keep inflation in the 2 to 3% range. That's ideal. You want to grow. You don't actually want deflation. You don't want to detract. It's not good for the economy. So that's really the main reason. And unless you guys know of any other reasons, because I'm trying to dig into this topic more myself. So the main reason the Fed raises rates, because that's the only thing I could really see, is that they want to control inflation. Because when you raise rates, less people are going to borrow. Because if mortgage loans were like 7%, and it's predicated on your personal credit history. So if you have great credit history, you never defaulted on a loan, you have a lot of cash in the bank, you might get a mortgage for 6%. But if your friend has a terrible credit history, they defaulted on some credit cards, they don't have as much cash as you, they may pay 8, 9% interest. And some people just can't afford that high interest rate. So raising rates, it slows the amount of money circulating through the economy, because less people are going to borrow. Do you think there could be a point where the national debt is too high to adequately raise the rates and inflation stays high? Yeah, I know. I think about that too. And I guess we're all concerned. But I kind of have faith, I guess, in the U.S. government that they're not going to get to the point where things are too out of hand, and it's going to crash the economy. I know people just always say that for decades now. Oh, it's too much debt. We can't afford it. We're gonna all be. It's gonna be a great depression like it was. I don't know. I don't think so. I think the government, our government, I don't know if everybody's in the U.S. here, but I think they do a good job at keeping things in a good range and not getting too out of control. Try living in like Argentina or which isn't even that bad relative to like South Africa and Venezuela, where inflation was just like crazy high. Because if you think about it, inflation wipes out your debt. Because say you had a $200,000 home loan, right? And you were making $50,000 a year. So it could take you maybe a decade to pay it off if you only have $10,000 or so of additional income to pay towards it. But if inflation is crazy high, and the average salary goes from $50,000 to $300,000 a year, because things are so expensive, like just to go to McDonald's, it used to be $5 for a Big Mac. Now it's $40 for a Big Mac. So inflation kind of wipes out debt. It makes your debt worthless because you can easily pay it off. It's just really a tax on savings. You can't go broke borrowing money that you can only legally. That's a great thing. They can just keep printing money. And it probably seems like it's getting too high, the debt. But I just think it's just such a strong economy. It's so powerful. I just don't see. I mean, I hope not, because if all the money we saved and all our real estate may be like crap if the economy goes like it is in like Venezuela or certain countries like that. So, but I want to try to learn more because I'm not really sure how or why. I can't really articulate it. I could articulate, like later on, I'm going to explain why interest rates have a adverse effect on bond prices, and I'll show you mathematically, and so you can understand it. But I can't really like prove why high debt is not going to kill the economy. I don't understand it that well. I just kind of hope the U.S. government knows what they're doing. So raising rates does drive down demand, because as things get more expensive, you spend less. Certain things you have to spend, like you have to get gas for your car. Like there's just no way around it. You need to get to work. You need to pick up your kids from school. You need to get groceries. Certain things you're just gonna have to spend money on. But if things get really expensive, you don't have to go on vacation. You don't have to pay $3,000 a month for rent if you can find something for $2,000. Like that takes a few months to make that change if you want to find a cheaper place. But you have to like eat. You have to get to work. You have to go to the doctor. Certain things you kind of have to spend money on, but other things are that's elasticity. So like gas is inelastic, because even if prices go up, it's still people spend money on gas. Where certain things are elastic, where if prices double, triple for chicken, then people just stop buying steak or stop buying turkey. So after the pandemic, inflation skyrocketed. So the Fed had to step in, and they had to increase rates. Inflation was at 9%, and they increased rates 11 times, and they got it down to 3.4%, because you just can't have a successful country if rates are consistently in the double digits or 20, 30%. So even 9% is pretty high for us. And the problem is wages generally don't grow as much. So gas prices are going up like 20, 30%. Food prices are going up 20, 30%. But our salaries are only going up 10%, if that. Maybe you can compare a nation stock index with its GDP. Yeah. There's a lot of like comparisons. But that I do want to do a video on that to try to understand it better. But there's so many nuances to these things. It gets really confusing. But that's why I try to make these videos, even though I think people don't really watch these types of videos as much as they watch my DCF videos. But I do like doing these types of videos because I learn and I'm trying to understand it better. This is a really boring page, so hopefully you don't click away. But so who determines the Fed funds rate? So the FOMC, you might have heard that term before. It stands for the Federal Open Market Committee. It's a branch of the Federal Reserve System. So they determine the direction of the monetary policy. So it's just a group of 12 members, 7 members from the Board of Governors, and 5 presidents of Federal Reserve banks. The chairman right now of the Federal Reserve is Jerome Powell, as you probably are aware. So just some info about the FOMC, the 12 members. They meet 8 times a year. These are private meetings, so you can't go to the meeting. It's not open to the public. But in recent years, they've been providing feedback or what is it called? The notes to the meeting to the general public. And they do sometimes meet additionally more than 12 if they see a need for it. But I know they have 8 times a year where they meet privately, the 12 members. So I guess theoretically they can raise rates 8 times in a year or more, because if things are really out of whack, like there's extreme inflation or there's extreme poverty or something like really bad like that, like it was in 2020, they may meet more than 8 times. So they just discussed whether there should be any changes to the near-term monetary policy. So a vote to change the policy would result in either buying U.S. government securities in open market. So when the government buys securities, this increases the money supply on a bank's balance sheet. So when a bank has more cash on a balance sheet, then they can lend more. And when they sell U.S. government securities, this is kind of taking cash off of bank balance sheets, and the banks have less money. So it decreases the supply of money in the open market. That's a simplified explanation of it. So I don't know if these terms you've heard of. I kind of heard of them before setting up this video, but I never really thought about it before. So a hawk is interested in tighter monetary policies. So kind of like taking money out of the market. Doves are for stimulus. Centrists, moderates are kind of in between. So there's a lot of rates, prime rates, LIBOR, mortgage rates, credit card rates. But the 2 rates the Federal Reserve sets, which kind of dictate the rates everybody else has, are the Fed funds rate and the discount rate. We just spoke about the Fed funds rate, but it's the rate banks lend to each other, because banks do lend to each other. And right now it's 5.33%, so it's getting high. There was a time the Fed funds rate was 0, and in Japan it's like negative. It's been negative for a long time. And then when the Fed funds rate was 0, like during COVID, they kept cutting rates. People were calling their bank and saying, "Can I get a loan for 0%?" Which is not going to happen. You can't get a loan for 0%. The Fed funds rate is 0. That just is the rate the Fed dictates the banks can lend to each other. So the banks get money for free. But of course, the banks need to make money, and there's risk involved when they lend to somebody. So they're not going to ever lend at 0. They may give you a teaser rate. If you want to sign up for this credit card, we'll give you 0% for the first 3 months. But the banks have to make money, and it has to be a cushion for risk. The more risky you are, the higher the rate they're going to charge you. So even when rates are low, if you have a high credit risk, you might have to pay a 20% interest rate, or you might not even get a loan at all. If you're that high of a credit risk, you've been through bankruptcy, you may not get a loan. So the prime interest rate, that's like the interest rate banks charge to their customers. Prime is a low interest rate. You usually don't get prime for a loan. You might get prime plus 2% or prime plus something. But it's all tied to the federal funds rate, because when the federal funds rate is high, like it is today, you're paying, even for like a mortgage loan, which is a pretty low interest rate loan, you still might be paying 7+%, 8%. And it's pretty much tied to anything: mortgage loans, credit cards, business loans, etc. So that's kind of like the levers the Fed uses to control the economy. When economy gets out of hand, they may use one of the levers, increase rates or decrease rates, to kind of balance things out. The discount rate, which is another rate the Federal Reserve sets, is the rate at which the Fed, the government, can lend to banks. It's kind of like the last resort. If you're a bank, you don't want to go borrow from the Fed. Of course, when things are rough, you might have to, because you're not going to, obviously you don't want to default, but it's kind of the last resort. So that's why the Fed funds rate is usually lower than the discount rate, because the Fed would rather banks borrow from each other than have to get the Fed to lend to them. The Fed doesn't really want to get involved in lending, but of course, if they have to, their job is to make sure the economy doesn't blow up. So if companies can't get loans from banks, that means less money going into the economy, which means we are headed into recession. Well, we're I wouldn't say we're heading into recession, but it's not a good look when a business can't get a loan. If a business can't get a loan, then a lot of businesses will go out of business. Now, when that happens, the businesses who have little to no debt with strong cash flows benefit a lot, because they can buy these distressed businesses at a huge discount, or just buy parts of the business, property, equipment from the business at a discount. So the JP Morgans of the world, they keep getting bigger and bigger. The Bank of America's, the Wells Fargo, they get bigger and bigger because they scoop up these distressed banks. And that's something we see all the time. But it's like that with any company. If you own a furniture store and there's other furniture stores in your neighborhood that are defaulting, you pick up their business. You might even pick up their space. But obviously, if it's a huge trickle down effect, and if the banks cut off lending totally, then we would be there would be hell going on if they 100% cut off lending. But if they get a little tighter on their lending, like certain businesses aren't getting loans that are not as stable, it's not going to end. It's not going to be the end of things. Like the more stable companies will get loans, and then that's why companies merge. Because if you have company A that is pretty healthy, right? Like think of like, it's like I don't get it. Like A is a healthy company and B is struggling, but they're not out of business, but they've always been struggling with money. Then just A acquires B, or they kind of merge together, and now B is able to pick up to maintain its business and keep running its business. A gets a cut of B's business, and it's like the same thing as if you're creditworthy, and your friend or your child wants to get a loan, you co-sign for them. Because you're kind of like so you're creditworthy, and let's just say your son, maybe, I'm not saying is bad with money, but just maybe they're young, they don't have any debt out there, So they don't have much credit history, and they just got their first job, not making much money. So you have to co-sign for them. So the bank is looking towards you as the person who's going to back your son in case they default. So stuff like this may happen more often if people aren't able to get loans, because people need loans to they need a car. You could always rent an apartment. You don't have to buy, but you definitely need a car. And if you can't even afford a $5,000 car, you need some type of loan just to get it. Where were we? So discount rate is the rate. It tends to be higher than the Fed funds rate to encourage banks to borrow from each other as opposed to the Fed. And the Fed sets both rates. I'm not sure. They probably set other rates too. I don't know. But there's like a million different rates. Like there's a rate. You go to Costco. There's a rate for their Costco credit card. There's a rate and everything. And it's all tied. It rolls up to these rates because these rates kind of control things. Because if you're a financial institution like a bank, you don't have to charge interest at what the Fed tells you. You can do whatever you want, but you're going to lose money. It's kind of like if you had your own business. If you buy and sell TVs, you can sell the TV for whatever price you want. If you pay $400, you're out $400. You can't sell the TV for $300. You have to sell it for at least $400, probably more like $700-800 just to cover your expenses. So it's like a bank too. Like the Fed doesn't. You can pretty much charge whatever you want, but you're going to lose a lot of money. So these are kind of like the minimums. Okay, so here's a little more detail. 3 more slides. So the stock market and rates. So it usually takes like a year for interest rate changes to have a widespread effect on things. Because if the Fed say out of the blue goes, okay, we're raising rates from 5% to 20%. If I have a fixed rate mortgage, or even if I don't have a mortgage at all, if I'm renting, it's not like I'm losing money right away because the Fed says the rates are higher. If I have no debt out there, it's not like it really affects me at the moment. If I have a variable rate mortgage that's tied to prime, then yeah, it could be a little painful. Do you know stocks? Stock Mo? Yeah. Oh yeah, Stock Mo. Yeah. He's pretty good, right? Well, do you like him, Neil? Yeah, because if you have a variable rate loan on your car or on your home and rates go up a lot, your mortgage may go from $2,000 to $3,000 a month, which could kind of be painful and tough if you weren't expecting that. But if you have a fixed rate on your mortgage, higher interest rates will affect you eventually. Things get higher, more expensive, but it's not like you lose all your money. So it takes time. That's what I'm saying, for things to change. It's kind of like when you get a new job. If your salary triples at your new job, it's going to take time to earn money. It's not like right away you can buy a new house, you can buy a new car, and you might do that, but you should probably wait till you start earning the money. But just interest rates. He talked about interest rates well. Is that what he's saying? But the interesting thing is, rates affect the stock market right away. It's immediate, and it's usually premature. Like before the Fed even increases or decreases interest rates, the market adjusts, expecting rates to go up. So it's all kind of built into the price, even before the Fed cuts rates, because if the Fed thinks, if the stock market or the average investor thinks rates are going to get cut next month, people start buying stocks. They invest more, and vice versa. If they think the Fed is going to increase rates, they might start selling off their stocks. But it takes time for things to trickle in. But that's the fun part about the stock market. You have to kind of do things out of order. You can't wait for a company to make money, because by the time they start become profitable, the stock is already worth, $100 billion or $2 trillion. You have to buy it with the hope that it's going to go up in price. Yeah, at least 6 months ahead, sometimes even years ahead on stocks. If you could try to understand bonds, I think interest rates are very straightforward, because they're highly dependent. Bonds are highly dependent on interest rates. Not adjustable bonds are not. Fixed rate bonds are highly dependent on interest rates. So bond prices move opposite of interest rates. So I have an example. Hopefully it's a straightforward example, and people don't get confused. Sometimes it's hard to convey these things in a clear, concise way. I try to. So let me. So in my example, if you have a car loan, a 3-year car loan, and you pay a 4% fixed rate, and rates increase to 7%, your loan is worth less. Interest rates go up. A loan is like a bond, like a mortgage loan or car loan. It's exactly like a bond. It acts the same way as a bond. So that's why I'm using it in this example. It's not a bond, it's a loan, but it acts the same way. So your $50,000 loan is worth $46,000 as interest rates go up. I'm talking about from the point of view from the lender, the bank. Not in your point of view. Your point of view, if interest rates go up a lot, you're happy you locked in this 4% loan, because other people who want to buy a $50,000 car have to take a 7% loan, and you're paying 4%. So you're happy. Rates are going higher. Well, yeah, eventually they have to go higher. Oh, than this? Well, they're supposed to be a rate cut this year. They're not. I don't think there's going to be higher rates this year. But are you saying this year you think they're going to raise rates? Because not many people are talking about that. It's possible, but it's not likely. I'll show you the math behind this, so maybe it makes more sense. So from your point of view, you're ecstatic that you locked in a 4% rate, a fixed rate of 4%, because it saves you a lot of money. It saves you 3% a year, because your friend locked in a 7% rate because he can't get a 4% rate. And now if the opposite happens, you're paying 4% on your loan and rates decrease to 3%, your loan is worth more. The Fed is lying, bro. You got to research the LIBOR and SOFR transition. Interesting. Yeah, I'll look into it. So I'm talking about from the bank's point of view, your loan is the value of your loan goes up. So you had a 4% loan and rates go down to 3%. So the bank is ecstatic because the bank locked in a 4% on you, and they can't charge your friend 4% if your friend wants a loan for a $50,000 car loan, because the rates are 3%. So the bank is making more money on you than your friend because the bank locked in a 4%. You can refinance, of course, and that's what a lot of people do, refinance. But until you refinance, the bank is in a better position than you were. So I'll show you the math behind it. So this is how to calculate the bond price of bond. it's just you could just a simple plug and chug calculation. But if you kind of mess with the numbers, you can kind of see how things change, and maybe it'll make more sense. So if you had a 4% car loan, you might have locked it in last year or whatever, and it's a $50,000 loan, and you just pay. I just had an annual coupon. I'm sure it'd be like a monthly thing, but just to like make it easier to calculate, I just did it annually. So that means you pay $2,000 a year. I'm just going to assume it's like a balloon. You pay $2,000 year one, $2,000 year two, $52,000 year three. This is more probably like, this wouldn't happen in a mortgage loan. You'd be paying monthly payments and to pay down your principal and interest over time. And you could calculate the yield too this way, but it's too messy. It's just too much going on, and the purpose of the explanation would totally get lost in all the numbers. So that's why I kept it as a simple annual interest payment. And you might find plenty of bonds, I'm sure, act this way. They switched the world interest rates to a new rate during COVID. Yeah, I saw that they switched from LIBOR to SOFR. I could explain it in complete detail. If you want to be you could come on the live stream as a co-host right now. I could give you the link if you want to talk about it. I'm fine with that. Just email me. My email is in like description of the video, and I'll send you the link to this stream. Okay. So if the market rate is 4%, the value of your bond is $50,000 because you're paying the same as the market rate. So the way it works is in year one, you pay $2,000. That's interest. And you have to discount it by the market rate, which is 4%, which happens to be the rate you're paying. So it's 1 over. Anybody, if anybody wants to be a co-host, even if you have nothing to add, it's fine. You don't have to know anything about the stock market. You just have to be open to talking. And even if you don't want to talk that much, I don't mind. It's a good learning experience. So the value of that $2,000 expense, you have to present value it, is $1,923 in today's dollars. The value of in year two, that $2,000 expense is $1,849. Because if you think about it, say this was a really long, many years, this 4%, $50,000, and you pay $2,000 a year. Could you imagine in 50 years, $2,000 in 50 years is nothing. So you have to always present value it to see what the value of the future cash flows is in today's dollars. And then on year three, you pay the principal and that 1 year of interest. You have to present value that. And the way you do that is you take 1 plus the current market rate to the third power, because it's 3 years out. You have to take into effect compounding. There's plenty of websites where you could just plug in these numbers. You plug in your cash outflow, you plug in the discount rate, the coupon rate, and it'll give you a value. But I want to show you it kind of broken down. Now, if the rates, this implies your loan is worth $50,000. So if the bank wanted to sell your loan, say to another bank, or if your car loan was an investment, a security, say it was a bond, you don't have to consider a car loan. Say you own this bond and it was a 4% coupon, and $50,000 face value, annual interest payments. Somebody would be willing to pay $50,000 for this bond. That's the value of it in today. If you want to trade it today in open market, because the person who buys it gets $2,000 of interest income after 1 year, another $2,000 after 2 years, and another $2,000 plus the original principal back. So it's worth $50,000. Now, if and this is a 4% fixed rate. So say rates come down a lot, this particular bond, it probably won't go to zero because it's but just say it goes down to 2%. They cut rates a ton. So if you want to sell this bond in the open market, you originally paid $50,000 for it, but now you can trade it for almost $53,000. Why can you trade it for $53,000? How did you make $3,000? Because if somebody bought this 3-year bond from you, they're receiving a 4% fixed interest rate. And the same exact bond is trading at a 2% fixed interest rate. So they're earning more interest than the market. So they have to pay for that. They have to pay for that. Because why would you sell it for $50,000? You bought it for $50,000 when the market had a 4% yield. Why would you sell 50 when the same bond, if somebody wanted to buy it today, they'd have to pay $50,000 with a 2% yield, because that's what the rate is today. So if somebody bought it from you, they would be receiving a higher interest rate. Does that make sense? And say rates shoot way up. It goes to 9%. It works the reverse. Rates go up, bond prices go down. You just email me. What's my email? Let me just look. You could go on any video. Here, contact. Just email me, and I'll send you a link. You could talk about whatever you want. So if the market rate goes up, that means today, if somebody wanted to buy a $50,000 bond, it's yielding 9%. So they would be getting $4,500 in interest payments every year, because the market yield is 9%. So nobody would want to pay $50,000 for your bond, because it's only paying a 4% yield, and they're only getting $2,000 in interest a year. Why would they pay $50,000 for yours? They'd rather pay $50,000 for the regular market, the bond that trades in open market. So to compensate them, in order to actually trade the bond, you're going to have to lower your price a lot. So you pay $50,000 for the bond. Now, if you want to sell it, if you want to trade it, you have to. It's worth a little under $44,000. And the reason someone's going to pay you $6,000 less is because they're going to only earn a $2,000 interest, where if they just bought the bond in the open market, they'd be earning $4,500 of interest. Does that make sense? And it's only really for fixed rates. Variable rate bonds aren't really influenced by interest rates, not nearly as much. I think it makes sense, but I know it's hard to kind of like understand the dynamics of it. So the longer the maturity of the bond, the more it fluctuates with changes in interest rates. So if it's a 5-year matured, if it's going to mature in 5 years, it's not going to fluctuate nearly as much as a 30-year bond. And you can also do the same calculation we just did to see how that works. So when the Fed lowers interest rates, they're trying to fix a weak economy. It's cheaper to borrow, which encourages spending and investing, which can boost stock prices. Because the more people borrow, the more they spend. The more they spend, the more each business has, and the flow of money continues. But it does lead to inflation, and that's a negative. Dividend stocks tend to benefit a lot from lower interest rates. So utilities and REITs will benefit as interest rates go down. They generally benefit more than a regular company. Also, large companies with stable cash flows and a strong balance sheet can benefit a lot from lower interest rates. Because could you imagine a company like AT&T with all that debt? If interest rates go up a lot, they have to roll the debt. They have to pay down the old debt. So they might have debt. They 2010 debt they took on in 2010 matures in 2025. So it was like a 15-year debt. And they only are paying 2% interest. But can you imagine if rates are at like 9%? So they have to now refinance the old debt with really, really expensive debt. REIT is a low risk investment for real estate firms. I'm not sure what you mean. A REIT is a real estate firm. It's a real estate investment trust. So if you have a company with little debt, I don't know what a REIT is. Oh, it's just it's a real estate investment trust. It's just a company, and the purpose of the company is to buy real estate. So if you like Apple's a company, right? And when Apple went public, when they IPO'd, they did so they can get a lot of cash to sell more phones and computers. But a REIT uses the money investors give them, and they buy real estate. So there could be a REIT that buys, office buildings, and they only buy office buildings, and then and the way they give back to the investors is, say they buy $100 billion of various office buildings around the U.S. They find people to lease space in office buildings, maybe a law firm, accounting firm. They lease the space and pay a monthly payment. Say they pay $4,000 a month. The CPA firm to lease a space, and that money is used to pay the principal and interest on the mortgage that the REIT maybe got a mortgage from a bank to buy the building, and if there's money left over, they give it to the shareholders in the form of a dividend. With REITs, it's 90% of profits are supposed to go back to the investors in the form of a dividend. Similar to like an MLP and BDC, 90% of those profits should go back to the investors. But a REIT can buy anything, some REITs don't even buy real estate. They invest in mortgage loans. But they're usually good investments if you want a high yield, but some of them have gotten crushed in the economy. Instead of owning the property buildings, another company owns the property buildings and you invest in them. Yeah, that's a good. That's how that's how I explained it before, and I think that's the best way. ML Williams explains it perfectly. So if you want exposure to real estate, say you have your own home, you own it, and you're making good money, you want exposure to real estate, you could buy your neighbor's house for $1 million and then rent it out, right? And then charge like, $5,000 a month to the person who's renting it, and that $5,000 will maybe pay the mortgage you took on, or if you didn't take on a mortgage, you just keep the $5,000, and then you have to just maintain the house. You have to make sure, if the roof caves in, you got to get a new roof. If you got to get the money from the tenant, that could be a headache too. If they stop paying, you have to evict them. So instead of going, that sounds like a big headache for a lot of people. Not everybody, but a lot of people don't want to deal with that. So what they do is if they have $1 million, they just buy a REIT, and a REIT does all that stuff. They buy the real estate, they maintain it, they collect the money. If there's someone that doesn't pay, they may get a collection agency after them. So it's just a way to get exposure to real estate if you don't want to like deal with the whole landlord thing. Somebody said they emailed me. Did they? I don't see an email. Okay, but anyways, do you StreamYard? Yeah, StreamYard. Just send me an email. I'll just send you the link right in this chat, and I'm sure. Yeah, you can just click on this link. I mean, if you buy into a REIT, say as opposed to buying an investment property, if you buy into a REIT, there is less upside, and there is a chance you might lose money on that investment. If the REIT's not run well. But the thing is, when you buy real estate, you can make triple your money. Like, it's possible you pay $1 million, well, million's high, say $200,000, and then 5 years later, it's worth $500,000 the home. So there's much more upside and there's much more downside when you invest in real estate and maintain it yourself. So it's risky. Some people have the stomach for it. Some people enjoy it, especially if you're handy. Like you could fix things. Owning property might actually be a good investment. But if you're not that good, not that handy, you could still make money, but you just have to trust a lot of other people, and then you have to outlay the money if things go wrong. IIPR. Yeah, I looked at that before, IIPR. I forgot what the ticker is. Let me look in. Well, let me go to the. How do I see if somebody? Let me know if you try to join the chat, because I think I might have to leave and come back in. I'm not too sure. Present settings. Okay. I don't know. I guess it just there's a pop up. I use Streamline, but try to get my camera correct. Okay, let me okay, let's go back. Yeah. I hope there's a pop up so I can just bring you in. I think there is. I hope, but I think once I had to like leave the chat, but whatever. So obviously it's you don't want to just constantly lower rates because you don't want to get into a bad situation. But sometimes you have to raise rates. I think that the main reason is inflation. I don't think there's many other reasons. I guess you don't want a bubble because when things are good, people think it never ends. So they just keep spending and buying and taking on debt. Just like in the 2006, 7, and 8 Great Recession, people kept levering up, buying more real estate because they weren't even paying much. They were getting these really cheap loans, and they would just kept buying investment properties, thinking that as long as the value of the home I'm buying increases, which has been the past decade, I'm fine. I don't care if I have to pay this crazy, weird interest rate that resets and I'm paying like a huge yield. Okay. Okay, what's up? What's your first name?
I usually go by Hardcore Raider.
Okay, Hardcore Raider. Are you in Vegas or are you in the East Bay?
No, I'm not in Vegas.
Okay, because I live near Oakland, so
I'm just a Raiders fan, bud.
just a Raiders fan. Okay. Well, yeah. Thanks for joining. So you were saying that the Fed funds rate is a lie and it's all about LIBOR. I wasn't really sure what you meant by that.
Well, first of all, appreciate you having me on, and then I've checked out your stuff before, so you know, I guess one of the things I want to talk about, if I don't know how much time we have, because this is an extremely complicated topic, and a lot of people won't talk about it. For a lot of it's probably the most controversial topic as far as the stock market, investments, interest rates, and all of that, and I don't have any financial investments, depending on how deep you want to dive into this, but like I'm not going to benefit one way or the other. But there's just some things that, I would like people to know and understand about the transition and some of the systemic risk that nobody has talked about. And, so none of this is financial advice, I guess, is one of the things I'd like to, just kind of point out, So I guess with that being said, I guess before I kind of give my kind of take on this, like, I don't know how much time we have or if you have any questions before we start or anything like that.
No, I think we have plenty of time. So, take as much time as you need. Yeah, just, I guess I'm not even sure what you meant. So I guess I don't have many questions. Maybe I will. But yeah, feel free to explain your point of view, or you can ask me or anybody else questions if you want to as well. Or so I'll let you take it.
So the LIBOR to SOFR transition, like we don't like to kind of talk about like what I said essentially is that the Fed is lying about them going to, in my opinion, at least, I don't think they're going to lower rates. I think they want the rates to stay higher for longer. And there is inflation that they created, but I think we have to kind of really kind of explain what LIBOR was and the problem with LIBOR. Okay. So if you go back to the 2008 financial, or first of all, LIBOR is the interest rate system essentially for the United States and our allies. So it was like the US, the yen, the sterling, the Swiss, the euro, and for them to get the interest rates, it would be it was supposed to be based off the market, okay, and treasuries and stuff like that, and they would, to get that interest rate system, because you're right about what you said about the loans. Like if you get a loan at 4% and the rates are at 7%, essentially the lenders or the banks are going to lose money on the loan, right?
Mm-hmm.
Yeah. So back in 2008, or for them to get the LIBOR rate. So this affects not just the United States, just important to understand. It's for us and all of our allies. And this is like the top of the entire financial system. This is the
I'm
central
gonna
bank.
move out of screen, but I'm gonna still listen. So just keep going.
Okay.
FYI.
So for them to get that interest rate, so the central banks give loans to the smaller banks like Bank of America, stuff like that. Then those guys give loans to regional banks and smaller banks from there on out. And for them to get that interest rate system, essentially what they would do is take what it was supposed to be was take market transactions. You take the highest one out, you take the bottom one out, and then you get an average, what was supposed to be the interest rates. Now, if you look at it, and you also have to understand that this affects everything, even if people aren't even invested in the stock market. We're talking about commercial loans, which there's a lot of issues coming up with commercial loans coming due. I'll talk about that a little bit later. But commercial loans, you got the mortgage loans, you got student loans, you got car loans, state funding. Everything is tied to the what was LIBOR, which is now SOFR for the United States. Okay, and there's a big difference between the two rates, but it's really important to understand that when we look at 2008 and what happened during the financial crisis, it was because the housing market and a lot of those rates were adjustable interest rates. But to me, more importantly to understand is the fact that what people don't talk about is there's something called the LIBOR scandal. Essentially, the banks, all of them. I mean, a lot of the news media tried to say it was all about, and some of this is controversial, but essentially they were trying to say it was just like some of the European and some of the banks that weren't United States banks, but that's not actually true. I forget the amount, but they were fined billions for the LIBOR scandal after 2008. So when you look at it like that, and we look at Lehman Brothers and Bear Stearns that went under, it was actually the banks manipulating the rates because they kept raising the rates. And then Bear Stearns and Lehman Brothers went under because the rates were higher. Essentially, they got margin called and they couldn't pay the interest on the loans. So a lot of people don't understand that if you look at 2008 and what happened, what really caused it, it was actually them raising the interest rates. And it was the LIBOR scandal that caused Lehman Brothers and Bear Stearns to go under, as well as the recession that we had. Okay. Now, LIBOR has been in place since 1986. It was a rate system that we used since 1986. Okay. And the problem, there was a lot of problems with LIBOR. Okay. But they're not actually telling the whole truth about the systemic risk with SOFR, in my opinion, the new rate system. But essentially, if you look at the LIBOR scandal, what happened and the importance to go to a different rate system, essentially it was like the lenders, the central banks were like, we don't want to get stuck holding the bag. Okay. If banks took on too much risk, we want to put the risk on them. Okay. So you fast forward to 2018, they came to a conclusion that they need to move away from LIBOR and they need a new interest rate system. And again, we're not talking about like a couple $100 billion or, even $1 trillion. We're talking about the entire financial system got transitioned from LIBOR to SOFR, or for United States is SOFR. Like I said, it's US, it's the yen, which is Japan, sterling, Swiss, and then UK, which euro. So each of those has like their own new system. Okay, and I'll talk about the main difference between the two coming up here in a minute. So in 2018, David Bowman from the Fed was the guy that was put in charge to make this transition. He started saying that the banks, there were several things that he really like hammered home, and I have the video. You can watch it and you can do your own assessment. And again, none of this is financial advice. Everybody do your own research. I've done thousands of hours of research on this. It's kind of, one of the things that I've really dove into to try to understand kind of what they're doing and why they're doing it. Okay. But, so David Bowman from the Fed in 2018, started encouraging banks to switch their contract language for this new rate system. Now the biggest thing to understand about this is the contract language, as far as the risks, and I'll explain that in a minute. But there's other things too that he mentioned. One of the main things was he said not all banks will survive this transition. This is the guy from the Fed starting in 2018, before the virus and everything else. He said not all banks are going to survive this transition. He said other things that like some of the banks and their computer trading programs won't be able to trade on the new system. So they were putting it out back in 2018. Okay. Now, the main difference between LIBOR and SOFR is SOFR is supposed to be based off of the Treasury market. So what they're going to say and what they're going to tell you is that SOFR is a much more um, robust interest rate system. And if you add up all the derivatives, because this ties to the derivatives and everything, okay? Like I said, commercial loans, mortgages, car loans, everything, pretty much anything that's like a paper contract. And so if you add up, like for us and our allies, it was over 400 trillion in derivatives that had to transition to the new interest rate system, okay? And for the United States, we owned about half that debt, which is about 200 trillion in derivatives. Now, if you look at LIBOR and SOFR, the main difference is LIBOR, whether it's a 3, 6 month or longer, what they'll call LIBOR legacy loans. Legacy loans, essentially, which is one of the more important things to understand. The legacy loans are loans that are like long contracts, could be like 20 years or 30-year contracts. So, say you get a loan on a commercial building or whatever, you're going to be tied to that LIBOR interest rate at whatever interest rate you guys decided upon, and you're stuck in that contract. Okay. But with the LIBOR legacy loans, there's a huge systemic risk in that, because essentially, if you say you got a mortgage on your house or a car loan, right? Here's the easiest way I can try to explain it so people understand the legacy loan portion. If you got a car loan at say 4% or whatever, and say your car loan's $450 a month, and then all of a sudden the lender of your loan says, "Hey, we're going to change your interest rate to now a new interest rate system." Now, the new interest rate system for SOFR is essentially an adjustable interest rate system. They call it risk-free rates. They call it RFRs. The new rate system is a risk-free rate because it's risk-free to the lender, meaning if the rates increase a lot, the borrowers, unless it's a fixed loan, but like commercial loans aren't fixed. They're not fixed, and we have over like what, 900 and something billion dollars in commercial loans coming up. And so if they were projecting they were going to pay 3% interest on the life of that loan, and now they're paying 5%, that's a huge difference in interest that they have to pay. So, but the legacy loans, again, like, so if you get a car loan, it's say a 5-year, 7-year, whatever loan it is, and then all of a sudden the lender's like, we're going to change your loan to now a new interest rate system, and it's going to be an adjustable interest rate system. So now your car payment goes from say 450 to 500 and then 550. Now we get into the contract language, which nobody in the media has ever talked about this. It's insane. Okay. So, and this is why David Bowman from the Fed was so concerned about there being, about the banks switching their contract language. Now, if you had got a loan and it was supposed to be fixed or whatever, and they switched it to now a new adjustable interest rate system, you could sue the lender and you would get back pay, at least for the interest you paid, and it might void the entire loan. Essentially, you have derivative contracts that could be tied to LIBOR, which are legacy loans. And because they don't have contract language, the proper contract language in there stating that if LIBOR ever ends, this is the successor rate, and it's going to be a risk-free rate, or essentially an adjustable interest rate system. Because they don't have that contract language, there's huge systemic risk to the lender, and that the borrower could sue. So if you add up hundreds of billions of dollars in derivatives or trillions of dollars in derivatives, if they're a legacy loan and they don't have contract language saying that they can switch your loan to now a new adjustable interest rate system, you could sue them and you would win. So this is one of the biggest things. And this is why, if you go back, and I can send this to you on either now or later, because I have it saved, but the video from David Bowman, when he's in Chicago, like university, talking about this stuff, like he points all this stuff out even before the virus, right? So I guess before we move forward, do you have any questions like so far? Because I'll be honest, it took me probably like 6 months to like really understand this, and then probably about a year or a little more to like really grasp, things that they aren't telling us, and how like this could be a real like not good moment for us.
I'm taking it in, trying to absorb what you're saying. But just curious, can you tell us what you do for a living?
I don't care to disclose that. I mean, what I do, with all due respect, with what I do doesn't really matter. What matters is,
Okay.
what maybe they're not being honest with us about or don't want us to know about. And I'll be honest, like, even though I've known about this, I don't want to typically go and put this stuff out there for certain reasons. I've gotten like I've done some articles on it, and I've gotten kind of blacklisted at times, and even threatened by somebody, because this is this is huge. This is the top of the top. That doesn't get no bigger than this, and nobody talks about this stuff. But anything else you want to say?
No, I guess keep going. It's really interesting.
It'll melt your brain if you have anybody, even financial, like say so-called experts, like I've had discussions with people that were like, supposed to be financial experts, and they're like, well, my teacher said this. And I was like, your teacher's wrong, and it's just the facts, dude. I'm just pointing out the facts so people can do their own research on it. But so if you understand the contract language, okay, computer trading, there could be like a potentially a Y2K type moment. I don't think it's going to be that bad, but if you follow the markets, you understand that there's, between now and like 2025, there's like over $900 billion in commercial loans coming due. Now, the interesting thing about the commercial loan market, it could crash it's enough to crash the economy, just that 900 billion. And that's a drop in the bucket to the 200 trillion in derivatives. Okay. Now, originally the LIBOR to SOFR transition was supposed to happen at the end of 2021 for United States and our allies, but they had bumped it to where they had like Europe and like all the other countries expire by the end of 2021, and they extended the United States out a little bit. So as of right now, they're still running like the contracts that haven't expired, so the legacy contracts that haven't expired to put on the new rate system. They've extended LIBOR to some degree. I forget exactly what they called the name, but it's a temporary LIBOR. Okay. But the contract language and these contracts switching over to the new interest rate system, it's huge, because the problem with SOFR, okay, so if you look at it, you could pull up a graph, right? Because the Fed is, and people will say, it's much more robust because it's tied to the treasury market and stuff. Well, if you pull up a graph of SOFR, which is secured overnight Fed funds rate of 2019, I think it was like September 17th or September 19th, and you look at the interest rates, they jumped overnight because a bunch of bills came due. And I think it jumped from like, don't quote me exactly on this, but I think it was around 2 something percent to all of a sudden over 5%. So if we think that SOFR is that, and if you don't know, that event that happened in 2018 almost collapsed our entire financial market because that jump in interest rates. So for them to come out and say that there's no systemic risk with SOFR, when if you look at a graph of what happened in September 2019, it almost crashed our entire financial system. Were you aware what happened in 2019 by chance?
No, I don't recall this.
A lot of people weren't. So anyways, but if you look at a graph or you pull it up, you'll be able to see it. And you could just go up to, SOFR chart and then look at those dates and you'll be able to see what I'm talking about. But I'm not saying you have to do it now, but I'm saying anybody that wants to kind of look at that. So,
yeah.
There's, when they bumped the United States, like, transition to the new interest rate system, like I'll be honest, I thought it was going to create another like market crash. We saw a huge dip after 2021, right? Now there was inflation. They created the inflation, and then maybe we should get into why and how this happened and stuff. And part of it was the virus and stuff. But there's, I think, in my opinion, stuff that like, so everything I've told you at this point is like facts of my research, but I also have an opinion on something that I can't prove. But I'll kind of save that for maybe like towards the end coming up here. But I did think that when the U.S. LIBOR transition had to happen for the contracts, I thought we would get a lot of systemic risk. So I was actually surprised because my thesis of lots of research on this, I thought we were going to see something bad happen. Luckily, it hasn't happened yet because I don't want like bad stuff to happen to any of us. I've survived 2008, and that was the worst 2 years of my life. You know what I mean? Which motivated me to research this stuff to try to understand it at a higher level. So, when these commercial loans come due, right, with these payments coming up, is that SOFR, LIBOR versus daily?
This blue line is SOFR, the black line is LIBOR. Is this what you mean? 2019?
Yeah, see that? Yeah, so it was like 2% to like over 5%. That happened overnight. That little blip right there, that's insane, dude. You could get margin called if you had a lot of like risk or whatever. Like you could get margin called, and that could, if you don't come up with the cash, that could end up bankrupting your company. So that was an oh crap moment in our history that a lot of people don't understand.
Yeah. So what Rater means by margin call is if you have a lot of debt out to like a bank and you use that debt to buy stocks or whatever. Um, if they call you on it and they say you have to pay us back for everything we loan to you, most people can't come up with the money and they end up getting forced into bankruptcy. Um, you know, and that's a problem. People lever up too much when rates are low, and then they don't think things are going to go bad. That's how the in 2008 subprime crisis happened, because people kept borrowing.
Right.
Some people just took a loan just for their own personal home, not to like buy investment properties. But a lot of people who took loans to get a home didn't really deserve that loan. They didn't have enough money to pay it back, but the lender, the bank, didn't care because they just resold that loan into like a CDO or a CDS, and
Right.
they got rid of the risk.
Right. And if those
So,
loans are on a, like, depends what rate system, but they were like when they were tied to LIBOR, there was small, like, fluctuance, in that. Like, if now here I'll just tell you my opinion, okay? Maybe before we move forward. So, because it's a lot to take in, dude. It like I said, this stuff will melt your brain trying to
blow
understand
my
it.
mind. Yeah, I never heard this before.
Yeah, it like literally will, like, almost give you a headache because it's very complicated. So now I'm going to give you my opinion. None of this is facts of what I'm going to tell you right now. But I'm going to tell you at least my opinion of what I think happened and why they did it. Okay, because the contract language was the most important point. And you can look up the U.S. government, our Congress, did what's called the LIBOR Act, because there was a certain amount of the LIBOR legacy loans that they might be able to do, do the lawsuits, and there'd be huge systemic risk in the market. And that was only, I don't even think that was like $1 trillion or something. They were looking at a very small amount compared to the bigger picture. If we look at, say if the US had 200 trillion in derivative, debt, or loans or whatever, maybe not debt, but we have 34 trillion in debt right now. But if you look at the LIBOR loans of derivatives of 200 trillion, and you just factor in like how much will the central banks make on these loans for every 0.5% increase, so say their baseline was 4% or 3.5%. If they just raise the interest rates 0.5% over that on the $200 trillion in these derivatives, they're going to make crap tons of money off the interest. I'm talking tens of trillions of dollars in interest the Fed, our Federal Reserve, and the other central banks are going to make off those loans. So when people look at, you look at the Europe, right? What happened to Europe right before the virus? Their loans were almost negative. Europe had negative interest rates, meaning if you have a negative interest rates, it's like, I'm going to give you a loan for $100 and I'm going to pay you an extra 10, $15 just to take the loan. No bank can stay in business if you're taking a loss on the loan. So when the virus happened, and we look at the Fed, so here we're going to get an inflation, and we're going to get into just my opinion, okay, that I can't prove. But I think there could be some facts. I just can't prove it, okay? Because a lot of this, I understood it, but I understand why. And so when the virus happened, the Fed went in and bought up all these treasuries, bonds, and even assets. And technically, they're probably not supposed to buy assets, but they kept spending tons of money. And there were certain people that are like, why is the Fed spending this much money, to buy up these like bonds, treasuries, and assets? They went overkill. They way overshot it. We're all sitting here scratching our head like they should have pulled back long before they did. And if we rewind to what the Fed told us, they said we're going to leave interest rates near zero, because so the virus happens, they lower rates to near zero or zero. It was like 3 or 0.3% or whatever. And a lot of people went in and restructured their loans and stuff like that, because we all thought rates were going to stay low. And so they created all this inflation, and then they're like, oh, we have inflation, after they said they don't think we have inflation, and they started raising the rates. And so it was a head scratching moment where we're like, why would the Fed do this? Like, are they really this incompetent and this ignorant? I don't think they are. Okay. And the reason why I say that, here's what I think happened, which this is the most controversial thing I cannot prove. I think they had to go in, because if you think about 200 trillion in derivatives that have contract language, that you got to figure out a way to switch a ton of contracts to a new rate system so you don't get sued hundreds of billions of dollars, if not trillions of dollars. Okay. And I think the Fed went in, bought up these bonds, these treasuries, and these assets They bought the derivative contracts. I think they switched the contract language and then to sell those contracts back out on the open market. And now the contracts they sold were under the new rate system called SOFR. Without the virus, there's no way we would have ever allowed the Fed and the central banks to buy up this much debt. And now we're all struggling with it. They created the inflation. In my opinion, they created it on purpose. And this gets to my point of why I think they're not going to look, I don't think they're either going to keep the rates where they are, if not raise them. Because I think the central banks, this is kind of tinfoil hat theory, I'll be honest with you, but I think the central banks know that they're going to make a lot of money in interest off the loans, and they want to make that interest on the new loans, okay, which is now SOFR for United States. And, they'll do it at all costs. And I think they're going to do it until they break something and they really hurt us in a bad way. I hope I'm wrong, because I don't want any of this to happen. I don't have any financial investments for my thesis. But, when I look at what they did during COVID and what they're doing now, they've constantly lied to us, man. They've constantly told us, like, we're not going to, if rates are good, we think inflation's almost under control. We're probably not going to raise them, or we're not sure. They played this dog and pony show. Next thing you know, they're raising rates. They're raising rates. We've seen it for the last couple of years. And yes, there is inflation that they created. So I'm not disregarding that. There's not inflation. We all see it. We buy at the grocery store or wherever we go, right? But they created it. In my opinion, they created it for the LIBOR to SOFR transition. And I think they bought up these contracts and they sold them back on the open market. But that part I can't prove. But I wish there was somebody higher up on the food chain that could prove it, because I would love to see if there's any facts to it. But it's the only thing that makes sense to me of what they did and why they did it.
Wow. So are you saying, like, one of the biggest risks is that moving to SOFR is variable, so it's more volatile, the rate, so you have less knowledge of how much you're going to pay in the future? Is that what you're trying to convey?
What David Bowman said in 2018 is he said that the banks won't know the amount of interest that they owe on the loan until 5 days before end of quarter. So if you're getting a 3-month loan under the new SOFR, or a 6-month loan or whatever, you're not going to, because it's backward looking. Here's the key thing for anybody. If you doubt me, research and understand what risk-free rates is, because that's what the new loan system is. It's risk-free rates. It's backward looking. It's not forward looking. LIBOR had enough history where they could kind of project where the rates would be. SOFR is backward looking. You can go ahead and read that if you want. Or
I was going to say, so the term risk-free rate is not accurate, because there's nothing that's risk-free. It's just kind of a colloquial term. We use it in the United States saying U.S. Treasury bonds are risk-free. But in theory, there's nothing that's risk-free. There is some risk, although limited, that the U.S. economy will fail. There is limited risk. But I was just defining risk-free rate in case anybody was curious.
No, they came
about
up with a creative name that sounds great, but it's only good for the lenders. That's the thing about the new rate system. It's the lenders passing the buck to the borrowers, and the borrowers are going to be stuck holding the bag and paying the higher interest. So when all these commercial loans come due, what's going to happen, guys? Like, think about it. What's going to happen when if you had a commercial loan and now you're paying 5% or 4% or much higher, even a half or even a 0.5% different spread, if you have hundreds of billions of dollars in like loans, for like, say if it was commercial, buildings in Vegas or whatever, and now you have a huge discrepancy and you have to come up with a bunch of money to pay that higher interest on that loan, you could be screwed. And if you do the math, because not all commercial, like, there's different increments of when the loans could be. But if you do the math of when 2008 happened, when we bailed out the banks, okay, under the old system LIBOR, some of those contracts, in my opinion, another thing I can't prove, but there's 15-year difference between 2008 and where we're at right now. Meaning when 2008, 2009 happened, there was probably a lot of restructure of those commercial loans. And if some of them are on a 15-year LIBOR legacy loan, those contracts are coming due between now and the next year, and they could be at a much higher interest rate than they anticipated. So like, if the Fed, in my opinion, if the Fed lowers rates, we're going to see more inflation. If the Fed either stays where we're at or they raise the rates, they're going to break the system, and it's going to be really bad. And all it takes is for a couple more banks to go under, and we could be in trouble. So
Right. Yeah. No, it could cause a lot of pain if your if your rate increases. But generally, historically, when banks fail or companies fail, then a larger, like a JP Morgan, would swoop in. Or for commercial loans, if you can't pay your commercial loan, the bank is somewhat likely to help renegotiate the terms before getting to the point of bankruptcy.
right. But you kind of bring up a good point, because honestly, before even Silicon Valley went under, my consensus was, like, kind of towards the end of this, there's a couple like conclusions I had, but my consensus was this is actually a transition where the big banks get bigger, because I knew that like some of the smaller banks, just like David Bowman said, are going to go under and not survive this transition. But what you just said is essentially smaller banks going bankrupt, and they sell their assets for pennies on the dollar to someone like a JP Morgan, and then JP Morgan buys up those assets, and JP Morgan gets bigger. Like, what was the bank that JP Morgan just bought when the Silicon Valley happened? Was it First National Bank or Republic Bank or one of them?
Yeah, FRB, First Republic.
I think, maybe First Republic. But the point is like there was a systemic risk problem, and a guy like JP Morgan, or the bank JP Morgan went in, bought up those assets for pennies on the dollar.
Yeah. It's because if you own a company, say, like, not a bank, because banks are regulated. So say you have a dry cleaner, and there's you and another dry cleaner in your neighborhood, and the other dry cleaner goes bankrupt. Like, it's your option. You can just buy his business for a lot cheaper. But if he's in a lot of debt, you may not want to buy his business. Like, why would you want to take on all that risk? Now, the thing is with banks is they're highly regulated. So if a company like First Republic defaults, another bank wouldn't want to buy them because there's so much risk. Because the reason they defaulted is because they were a lot of debt. The great thing about the U.S. economy is we kind of we take some of that debt off, or help. Like JP Morgan gets help from the government for taking them over. Not so much help, but like JP Morgan steps in, so they're kind of getting rewarded. So they have limited downside when they acquire these banks. So it's more beneficial as a bank to acquire someone, because the Fed kind of stops the bleeding. Where if you're a regular small business, you don't get that support from the Fed. But yeah.
Did you want to get any of the comments, or anybody that had any questions, or do you want me to address any questions? There's a couple people in there that, and there's probably more, but it's so complicated. Like, I don't want to overwhelm people too much, but that's the main, I guess, my consensus of why I said I don't think they're going to lower the rates. Maybe I'm wrong, guys. I hope they do to some degree, but if they do, they're in a situation, man. And if we have a bunch more of the tough legacy LIBOR contracts come and due, it could be another like what the heck moment, and it could put us in a very bad situation. And again, I hope not, because I'm not praying for this. I don't want anybody to struggle. But because I know like how bad it was for me in 2008 and stuff, man. But hopefully they get this thing figured out. I'm not convinced they will, because if these companies go under, just like we explained about JP Morgan buying in assets, like, what do you think is going to happen? Some of these people, these other smaller banks that have these commercial loans, they're going to go in and buy up the assets, and we're going to see a huge, like, could be a scary moment between now and the next like year or so. That is correct, David. So yeah, the David Bowman, that's the one I was talking about. And you can listen to it. I've listened to it probably 20 times, but here and there kind of thing, but I'll listen to it while I'm working. But that's the one I'm talking about. So I'm not familiar with Tom.
Are you pro Bitcoin? Somebody asked.
Oh, I don't have anything against it. This could be, I mean, if a bad enough moment, here's what I will say. If a bad enough moment happens, I could see the central banks wanting to switch us on some sort of, Fed coin or something like that. I know there's been talks about it and there's a lot of speculation on that, but I think ultimately that's the end goal, whether it's a year or 5 or 10 years. I think it's inevitable at some point.
Yeah, I mean, I think the market is pricing in lower rates, but they have brought down inflation a lot. So I don't think a cut is as like crucial as it was last year. So,
well, if my thesis is right so my main thesis on this, besides big banks getting bigger, the contract language, the other part of that would be, I think the Fed wants to make money off the new rate system. And so whether they leave rates where they're at or they raise them, like if you look at a chart of the US 10-year, and if you look at what happened in the 70s, and if you have like some SMAs or some stuff on your chart to kind of like analyze what happened in the 70s, I think the charts prove that we're hitting a cycle just like the 1970s, meaning when mortgage rates were 15%. I think even if they were to lower them a little bit, I think if we look at 10, 15 years from now, I think we're going to see mortgages just like the 1970s, which is crazy to think about now. But we might be looking at like 5 or 10 years from now and wished we would have got a loan at 7% or something, Remember, and one of the things I forgot to say, I apologize. Never in recorded history, guys, has the central banks or any world leader of a debt system or a lender moved the world debt to an adjustable interest rate system. Never in recorded history have they moved the debt to an adjustable interest rate system. Now, the United States and all of our allies moved it to this risk-free rates, which is an adjustable interest rate system, which is crazy to think about. So, over $400 trillion in derivatives, guys, moved to this risk-free rate system.
Two types. This was a chart in my PowerPoint slides. This is the Fed funds rate since the 50s. So could you imagine the low rate was above 15%? So if you were a genius and you locked in, like you took on like a 20-year treasury note with like a 15% interest rate, pretty much a zero risk investment at above 15% annual return, like everybody will put all their money into that. But you think our economy is bad now. Could you imagine how it was when it was above 15%? Insane,
dude. How could we even survive off that, especially with the way food prices are right now? It's scary to think about. Like this is why they won't talk about like this transition. Let me just ask you, have you heard anybody in the mainstream media or anything ever talked about LIBOR to SOFR? And if they did they talk about if there's any risk to it? And did they point out the chart from 2019 on SOFR?
I've never even heard it at all on
almost no one has, brother. You're not alone.
Show any podcast. I haven't heard really anything on it. I know a little about it, but I just never really looked into it much.
They don't. I'll be honest with you. They don't want this information to get out, and probably because they don't want to scare the market. To be honest with you, I mean that's probably like I get it. They don't want to freak people out, but I think they know exactly what they're doing, and which is wwhy they lowered the rates to zero during COVID. My thesis is why they lowered rates to zero. But they knew about this since 2018, guys. This wasn't like an anomaly. All this transition was coming up. And this is why, in my opinion, I think the Fed bought up all these contracts and then resold them, and why they keep raising the rates and, acting like they're not, and everybody gets hoodwinked. But that's just kind of my opinion of it. But
yeah, could you imagine having a loan thinking that because the thing about fixed rate is that how much you're going to pay. Even if it's a high fixed rate, you could plan.
Right. Exactly.
You don't want to pay a high rate, but if rates are high, and you need a car, you need a home. So, but you plan ahead, you save a certain amount. But if things are switched up almost last minute, where you think you're paying this fixed 5% and then it suddenly doubles because things are variable, that could put you in a really difficult spot. Maybe even bankruptcy for some people.
Well, and not just that. If you pull up the U.S. Debt clock, That one's kind of interesting to look at. During COVID, it was almost doing a reverse when they lowered the rates to near zero. But if you look at that now and you count, when he pulls it up here, I'll show you. But when you pull it up, if you count the amount of like our debt is increasing, every $100,000 is about 4 to 5 seconds. So the U.S. debt is increasing like every 4 to 5 seconds by $100,000. That's nuts. So it's like if you had kids, you said like, "Hey, good night, I love you." By the end of that, there goes $100,000 increase in our debt.
Are you talking about this? I've never.
Yeah, that. But there should be one where it's not just a picture where you could like click on the link and it should show you that
a moving thing.
Say again.
Like it's increasing. The number is increasing. You mean like?
Yeah,
it's a lot.
Yeah. You should be able to pull that up and click on one of the links, and we'll show you.
That's in Manhattan. They have in a Union Square. They have a debt clock.
Yeah, click on that one right there. Try that one maybe if you don't mind. Yeah, there you go. So see that? You look at the debt. Like, see, we're at 30 U.S. national debt. We're at 34 trillion. So like $100,000 every 45 seconds. It's insane, dude. And as the rates increase, guess what?
Yeah. So who pays the debt? It's kind of like if you have all this debt, and if you die, who's going to pay it? Your wife, your kids. I guess
we're borrowing for future generations, man.
Whoever's left over is gonna.
Unless they break the system and then try to push like a one world currency or like a Fed type Bitcoin. I'm not saying Bitcoin. Oh, give me a second.
They should do one currency for the world, but that would probably hurt the American economy to have a currency linked to every other economy. Well, they kind of have the, I guess crypto is universal because it's not for one. And probably the most universal non-cryptocurrency is the US dollar. That's pretty much universal where most countries use it or accept it. And it's not that way with other currencies. So US dollar is probably the most accepted, even though we have the most debt. State debt clock, world debt clock, time machine.
And I think so. It's hard for me to see on my screen, but I think somewhere on there it says the interest. I'm trying to look and see if I can find it on there. It might be down a little bit, but where is the interest?
It's a lot of numbers. Just like us in Europe, we are sharing a currency with countries like Italy. Yeah, the euro. A lot of people are unhappy. I guess that's why the UK didn't want to be part of the euro, because it's like being responsible with your money, but then your neighbor is not responsible, but you have to share things with him. Well, I don't have to share with this person. I want my own.
Well, the deeper part of this is to understand what globalization is, when it happened, why it happened, and then the other part is understanding the BRICS nations, when that started and why that started. So globalization is something that started after World War II, where it was the United States and our allies. Essentially, we got put in charge of where they're going to use our dollar for trades. We're going to allow open seas or, freedom for open trade, and us and our allies are going to benefit from it. And then you fast forward, and there's more to it than that. But then you fast forward to the BRICS nations. That's where China, Russia, Iran, North Korea. But like back then, it wasn't as many countries. But the BRICS was created to bypass the Federal Reserve and the central bank system. So essentially, the central banks aren't going to be making money off of those transactions, and they're doing away with the U.S. dollar and our banking system. So, we look at a lot of, not to get too political, but you look at wars, some of the stuff happening, a lot of it ties to this transitions, going back, I think it was 2010 when China created the BRICS nations to try to do, trade deals without the US dollar. So.
Yeah, no, a lot of things, a lot of scary things you're bringing up. Hope, but it's really hard to know how these types of things will interact with other things. It's kind of like with a stock, like you try to identify all these things like, oh, they have too much debt, or they don't have much debt, or their revenue is going this way. But then you look at a few things, but there's 5 other things you don't think about. Like, so it's very.
Yeah, and I don't want to. I'll be honest with you, man. I don't want to be a fear monger. I appreciate you having me on here,
Yeah.
but like, I just want to get like some honesty and truth out, and try to, you know, anybody that can do their own research, if they have a different opinion or they can have their own analysis of it, and maybe I end up being wrong. Like I hope I am. Because I'll be honest, this stuff like scares me. It's very complicated to understand, but just so hopefully other people understand and do their own research. If the Fed keeps raising rates, yes, it's because of inflation, but more of it is LIBOR to SOFR transition. Okay. And in my opinion, it was their plan the entire time, which is why they lied to us, said they're going to keep rates near zero. And all of a sudden they're skyrocketing them and all this other stuff. So, but some of this, some of that I can't prove, but we've seen, you look at a chart, you compare it to 1970s. I think we're right in that cycle. If someone just understands how to read charts and stuff, stock charts, like the US 10-year, you can find it on there. You can do your own analysis of what kind of cycle we might be in.
Yeah,
and if you put up SMAs, like a monthly chart, I believe it is, I think it's like the 200 SMA or 250, like never, like since early 1980s. So it's like 70s, the interest rates went like this. Okay. And then the 80s, we went down, and there's fluctuations, but essentially we went down until the virus, right during the LIBOR to SOFR transition. And then all of a sudden the SMAs, went from being like resistance to then all of a sudden now they're support. And now we broke above those lines and now it's pushing us up higher, especially if you look at a monthly chart, but in longer time frame. So the point is it broke a trend that like had never been broken like since the cycle of the 70s, which is crazy.
Right. So in case anybody didn't know, so SMA is simple moving average.
Mm-hmm.
So like 50 SMA it looks at the past 50 days, right. Sums up all the numbers and divides by 50. So it gives the average of the past 50 days, 200 days, 200-day average. So because it's going to always be bumpy on an individual day or time period, but this kind of smooths out the number so you can see where how it moves over time. Charles said, only way to fight a recession is to lower interest rates. What incentive to that is a big way to fight a recession, to lower interest rates, and we did that for almost a decade. It seemed like we had near zero interest rates until COVID hit. Then things blew up, but now we're back to all-time highs in the market. So
yeah,
everything's fine.
Hopefully, we'll see.
Everything's fine till it's not.
Well, and one of the other things, like, I've listened to, Jerome Powell for years and stuff. I kind of like listening to some of the stuff. It's probably boring to other people, but all these reporters and like throughout from 2018 until, say a year ago, Jerome Powell never once really mentions LIBOR to SOFR transition or SOFR. I mean, we went from a previous rate system to now the new rate system is based off of secured overnight Fed funds rate, which is the Fed. And yet Jerome Powell knew about this the entire time. And he never once talks about SOFR or any of this. They'll talk a little bit about the repo market and stuff. But and then is it March 8th or 11th coming up here? They have the, like that lending window, that they had or whatever, that they're going to cancel it. That they kind of opened up when Silicon Valley went under. So that's kind of scary too,
So
I think
what was that? They're not going to do the lending window, because
I forget what it's called. There's a lending window they did. for like when Silicon Valley went under, and yeah, they're doing away with that lending window.
I didn't know that. Well,
Yeah, it's like the 8th or the 11th.
why don't banks use a discount window?
Yeah, I think that's it. It was a special. I don't know if it was the regular discount window. Like I don't think it was the repo portion. Because repo is still open. It was like a special window for banks that had systemic risk.
Right. I mentioned it earlier that that's why the discount rate is higher than the Fed funds rate, because the government wants banks to lend each other, not where the Fed has to fund the banks. That's kind of like a last resort. But there is that window that banks do have access to the government. Since banks are kind of federally regulated, most industries are not. So most industries can't go to the Fed and just get money at a really low interest rate. Banks can, because it's just such an important industry to keep control of. Because if the banks fail, it's kind of like your economy fails. It's that important. But yeah, it's a lot to take in. And I always get confused with all this stuff. Like I mean, I understand it to a point, but how it kind of fits into like the big picture, it's like so many moving parts. So I don't know if you guys are watching, but if you're slightly confused, I think most of us are a little confused, because it's a lot of things to think about.
For sure. And what I'm saying is more of a long, like, a year, or could be 5-10 years, kind of cycle. So like swing trading, day trading, it doesn't really affect that. Like there's still going to be probably opportunities. Could be. I mean, if worst case scenario happens, I mean, it's going to suck for all of us. But those that are maybe more better position will be ready to buy probably stuff at a discount, I would imagine. So,
Right. Well, that's what usually happens. Like if you save a lot of money, you don't have debt, you have a nice reserve. When the shit hits the fan and Meta is trading under $100, like it was, you can buy it, and when it goes back up to 500, you get all the upside. But if you have no cash to buy it, then you can't benefit from those discounts.
Or if they send us in a recession or something worse, then a lot of us might be struggling to try to even have cash to do those opportunities,
Well, then we'll just need money to eat. Can't really afford Okay, Maria, thanks for sticking around. I'll talk to you later. Yeah, it's interesting stuff. And I mean, there's just so many things to think about. And I wonder why this is not talked about, like why people don't ask about it. Because there's a lot of people, like I understand why the person who's running the interview might not talk about it, but there's people who ask questions. I wonder why this question isn't asked. Maybe just people don't understand it.
No, well, you're right. A lot of people don't understand it, but I don't know. There's certain things that like I feel, but like I don't want to put that out on your channel. I'll just say everybody should do their own research, and there's definitely a reason why they don't want this information to get out. You know what I mean? And yeah, part of it's that it's complicated, but more part of it is probably along the lines of corruption. And you look at $400 trillion for the United States and our allies that had to go to a new interest rate system. If my thesis, if it's correct that they had to buy up contracts and switch the contract language, which is what I think they did during COVID, then there's no way they would be willing or able to talk about it. You're talking about switching, at least for the United States, possibly 200 trillion, or at least a portion of that, even if it's $50 trillion in derivatives to a new interest rate system. And you had to have something happen to where you could buy up all those things, all those paper contracts, switch the contract language, sell them on open market. That's my end result thesis. And that wasn't my conclusion at first. That was after researching it for a year and a half, when it really made sense, because a lot of this didn't make sense to me at first. And where we're at right now, I just think that as I've thought about this, I think that was their true intention the entire time. And we supported them. We're like, yeah, go and buy up all this, money and stuff. Now we have inflation. A burger is like double. Like some of the stuff's almost double what we were paying before the
Yeah,
virus. We're all sitting here
crazy.
scratching our heads. You go to the grocery store or restaurant, and you're like, where did all my money go? We probably have less money. We might make more money or whatever. We have less money at the end of the day, after paying our bills and everything else, than we did before the virus, which is nuts. None of us really benefited from any of this. So
No,
who benefited from it and why?
I definitely have less. I'm making less. I'm not even making more money. I'm making less
Yeah.
money. I just don't spend anymore.
Yeah, me too, brother.
No disposable income anymore. Unfortunately, it's crazy. Yeah, I went to get a slice of pizza. It was $7. I was like, $7. When I was a kid, almost a whole pie was like 10, and I got one slice of 7.
Yeah. No, I hear you. I wouldn't even eat at McDonald's anymore. I'm like, wait, there went how much? I'm like, I'm not paying that. I'll eat a peanut butter and jelly or something else. I've had to be a lot more conservative with my, like you said, extra income. I used to, be at a point where,
when McDonald's gets expensive, then things are bad. That's when things are bad. He's been had a recession. Own shares of dividend aristocrats. Well, I mean, I've said this before. Inflation is pretty much a tax on savings. So,
right,
if you have your money in assets like stocks or real estate, you're moving, in theory, with inflation. But if you have a lot of cash in the bank, your inflation is just eating away at your cash.
Well, and typically, so people think that bonds is a hedge. And under some circumstances, it is. But if you look at a chart of bonds have kind of decreased in value. So typically, if rates go down, bonds go up. If rates go up, bonds decrease. So
Right.
I'm not even convinced bonds is a good hedge. The only way bonds is a good hedge is if you think the Fed is being honest and not lying to us, and that they're going to lower the interest rates. If the Fed does lower interest rates, then bonds will be more valuable. If the interest rates keep rising, then those bonds become not worthless, but they're worth less money.
Right. So yeah, bond prices move opposite interest rates. That's a fixed interest rate, but if you get a variable interest rate bond, then you're moving with it. Maybe not 1-to-1, but
right. Well, and keep in mind, guys, that commercial loans, like these buildings, like you see Vegas, all these big buildings, almost all those loans are business loans. Business loans as well are all adjustable interest rates. That's just the way that those loans are usually structured. So if they projected, like I was saying before, if they projected they're going to be at 3 or 3.5% interest, and now they're at 4 or 4.5 or 5%, or higher, they got to cover that spread difference, and that's a big, that could be not good.
Yeah.
And dividends, if we hit, like, so what Williams is saying, in my opinion, at least, if we hit a recession, a lot of those stocks and those companies, if you look at throughout time, they stop paying dividends when they're not being profitable, or if we hit hard times, no matter the company, whether it's Coke, Pepsi, whatever dividend stock, you want. A lot of those companies will either stop doing dividends during those hard times, or they, at least decrease doing, dividends nearly as much. So dividend stocks, in my opinion, at least, I don't think dividend stocks are an exact hedge of it, and neither is gold. People say gold's a hedge. If you look at a gold chart, gold goes down with everything else. It might be one of the first to recover after we hit like a bottom, but look at a gold chart, it goes down during recession moments as well.
It's true. Yeah. I've noticed that too. Like gold, it does not. When a market crashes, gold goes down with it. It's not really. It may go down less, but it goes up less too when there's a.
Right.
But I didn't realize that most commercial loans are adjustable. I didn't realize that.
Yeah, CRE loans, yeah. And then you look at the term. So this gets into like what I can't prove. My question, because I have more questions than answers, even though I've tried to give some like my thoughts. But those CRE loans right there, those commercial loans, how many of those were given in 2008, 2009 when we bailed out the banks? You remember not to get too political. Remember Obama said all the bankers were going to go to jail and prison. None of them went to jail. We bailed them out, and then you have to look at like all these commercial loans come and due. So how many of the commercial loans come and due are from the 2008, 2009 crash, and they were on a 15-year loan? I don't know. I wish somebody would put that out there. I do know it's something like 900 and something billion come and due. And a lot of people are talking about that and how regional banks are at a huge risk coming up here.
Well, yeah, that's information like the banks don't have to share. So that's a lot of, like, we don't know if a bank lends to a private business, like, which they probably, most of the loans are to private companies because there's so many private, medium and small businesses out there. Like, we don't really know the rate. If it's a public company, we could maybe find it out if we look through the 10K. But yeah, that's yeah, I was talking about this recently with somebody about commercial loans because I do some bookkeeping for some commercial real estate companies. And yeah, it looks like in the next 12 to 18 months, things could be a little rough because of, it's getting more difficult to fill those spaces. And if you're not profitable, you might not be able to pay your loan.
Yeah. No, that's scary, man. I know.
But yeah, any other questions? T-bills. One example, Coca-Cola started dividends in 89 and they never gone down or stayed flat, always gone up each year. Yeah, some companies always increase their dividends, even though they probably shouldn't, but they want to do that because they don't want people to get scared and sell off their stock.
Right.
But generally, companies start with a pretty low dividend and just increase it, a few percent each year, just to maintain that. But always look at the balance sheet and statement of cash flows, because if they're funding the dividend with debt, that's a really short-term plan because you can't fund your dividend with debt
Right.
in the long term. You got to be profitable at some point. But
Yeah.
it's hard to identify these things because you do see these companies struggling, but how do you know which are the ones that are going to figure it out and start becoming profitable?
Well, and also one of the last things, I guess, if you look at 2008 and how people's pension funds and 401ks got hit, and then we look at and I'm older, but there is a generation of the boomer generation that are retiring and wanting, to, reap from their benefits, and rightfully so. But I'm not convinced the banks are going to want to pay those 401ks and pensions. People with, excuse me, people with pension funds and 401ks got robbed during the 2008 crash. Eventually it recovered, but those people got hurt real bad. And, that's something else that, I'll be watching to see, if they're going to do something with some of the older generation wanting to, retire and whatnot. So,
yeah. Pensions can be at risk because if you say you worked for GE or Ford or General Motors for a few decades and then you're retired, so your pension is really reliant on that corporation staying in business, because if they go out of business, it's not like if you were a teacher, because the U.S. government's not going to go out of business. It's almost impossible. But if your pension is tied to a corporation like General Motors, who pretty much struggles, it seems, all the time.
And I don't know, man. Most people disagree with me on some of the stuff I've said, and this one probably for sure. But I think the Fed is looking at some of this all wrong. Essentially, they're going to keep raising rates until they break the system, right? Which we talked about, supply and demand. So the Fed is trying to kill demand, so that way, none of us want to do stuff or whatever. How come we can't figure out a way to pick up supply to fight inflation? So instead of like, manipulating the market or whatever, raise the interest rates to break the system, rob from us, why don't we figure out a way to pick up our supply so our supply meets our demand, And maybe that's easier said than done, but they always look at these, in my opinion, kind of fictitious unemployment numbers, and how they want to get unemployment to a certain percent, and then that's their trigger mark or whatever it might be. But
Right.
the way I look at it, like, why can't we just figure out a way to pick up our supply to meet the demand instead of lowering demand? It seems kind of back ass words in my opinion, but
Well, they had to fight inflation, which they did a good job bringing it down to about, what is it, like 3.5%
I think
from
it's
like
like 3.
9.
Yeah, I think so.
But I don't think you think demand is really that low. You don't think U.S. companies have been putting out pretty good earnings this past few quarters?
You have to look at, like, when they look at the unemployment rates, like who they're counting and who they're not counting. And there's a lot of speculation how they go about counting the numbers to get their whatever,
Right.
So I think there's some questionable stuff how they calculate it, if those numbers are accurate, and I don't think they are. So in other words, I think unemployment is probably a lot worse than what we're seeing.
Well, yeah, the way they calculate it is if there's like 100 people, and 95 are employed and 5 are unemployed. So this 5% unemployment rate.
Yeah, but
if
they don't count people that stop looking for work. They don't count people who are working 2 jobs instead of 1. So
Right.
there's
Yeah, I was gonna.
people
Yeah.
fall out of the system. So those numbers are not exactly honest in my opinion. Not saying you, I'm saying what they come up with
No, yeah,
may not be showing the real picture.
I was leading to. So it doesn't look terrible, 5%, but then 2 of these people from the 5, after a year, they just give up and they kind of like they're not even part of the equation anymore, because if you stop looking for a job for like or are unemployed for like 2 years, you fall off the scale. So those 2 people aren't even looked at. So you might have like maybe from this original 100, you might have like 10 people who are just totally out of the equation. So it might be actually a 10% unemployment rate if you included all these people who aren't even calculated. I think that's what Rader was trying to say, which the numbers don't really tell the whole story.
Well, Neil Weston said something about 20 million immigrants. So this is another thing that's political. I don't want to get too much into that, but I'll just say both sides of the fence, no matter where you stand on the issue, and something that nobody's really talking about is that, our government has used immigrants coming over to help fight inflation. No, nobody talks about that, but like both sides of the fence for a long time have wanted, immigrants over here to help, bring that demand down or to raise supply, because they'll work for less, to bring a more like kind of median kind of mark. So, I'll just say that, like, when you have immigrants, it helps fight inflation. That's the easy answer, and a lot of people forget about that factor.
Okay. So if you want to know the real unemployment rate, they actually do include, if you like, the unemployment rate they advertise is not the real unemployment rate. That's when they exclude a lot of people who stop looking or maybe aged out of the system, they retired or whatever. So the real unemployment rate is closer to 7%. That was in 2022 though. Yeah, but you would think they should include everybody as long as they're under like 65.
You'd think so, but so you're talking about companies with profits. Well, a lot of them have either cut off at, or they've killed the demand. They've let people go. There's been, some of these big companies have laid off a lot of people, you know what I mean? And so, I look at it like that, like, yeah, their profits might be up, but that's also because they had to cut a lot of their people, to some degree. So,
well, yeah, like Meta did a good job of cutting staff to trim the fat. that's part of the business.
It is, yeah.
Like that's, but you can't cut expenses. Like you can't grow a company by cutting expenses. You could make it more profitable, but in the long term, you can't cut to negative. So at some point, you have to grow revenue. So
right,
it's
which is which is why I said pick up supply. Figure out a way to make the supply meet the demand. But sorry, go ahead.
I forgot what to say. I'm trying to figure out the how they define unemployment. I think it's just if you've been out of the workforce for a certain amount of time, you drop off. But it's interesting. So if you're like 30 years old and you live in your mother's garage for 20 years, you're not part of the system anymore because you're considered like not even a person who's within the calculation.
Mm-hmm.
And so if you have a million or a few million people who are doing that, it does drain the economy because when you have people not working, not contributing,
right,
it doesn't. We need tax dollars to function as a society and goods and services. The terminal player first. Yeah. So any other questions? Meta's a parasite. I don't know about that, but I like Meta.
I'm curious what you think about artificial intelligence. William said something about that.
I mean, it's definitely it's way overhyped, and I don't think anybody, even if you are pro AI, you can't. It's extremely overhyped, which is just how it is. Like the same thing happened with EVs, or the whole green initiative. If you had anything to do with EVs, even if you were losing $1 billion a year, your stock went through the roof. But it's always like this. There's always a new thing, and it's kind of it's the same thing that happened when cars became really popular and started becoming in the mainstream in the early 1900s. But there was so many car manufacturers. Everybody was trying to be a car manufacturer. So all those companies got all this funding, but now, how many survived? Maybe like a half a dozen, Ford, GM. And the same thing happened. I don't know if you guys remember in the 90s when all these .coms, there was thousands of them and they were all valued so high. But now, like, who survived? Just like a handful. Amazon, eBay was one of the early ones, but so this is just a new thing. Who's going to survive though in 20 years? Everybody thinks Nvidia will. I guess they have the best chance, but Amazon stock went down like 90% in the .com crash, and they probably would have gone bankrupt. Didn't they get like help from somebody, from an investor?
I can't remember, but I do know Jeff Bezos. He stepped down from CEO. I think it was last year before, and he sold a crap ton of stock that he didn't sell previously. And then he's going through another staunch here recently, gonna sell a bunch of stock. I forget how long. I think it's next year or within the next year or something. But
he's been selling a lot. So is Zuckerberg. He's been selling a lot too.
Yeah, which is usually, I hate to say this, but I don't want to fear monger, especially on your channel, but usually when you see CEOs or ex-CEOs selling large portions of stock, it's usually a telling sign before something potentially might be happening in the economy.
Yeah, no, it could be. But a lot of these stocks are trading at all-time highs. So, I mean, you can't, somebody who's put decades of their life into something, they deserve to be rewarded. So the thing is, when somebody sells, you don't know why they're selling. I mean, you could have your theories why they're selling. They may really think the stock's going to crash. Or they may just think it's high, and I would like to get some money so I can have more savings. I want to go on a nice vacation. I want to buy a new house. So it could be a lot of things. So you don't know. But when someone buys, you kind of know why they're buying, because they think the stock price will go up.
Right.
That's usually not many other reasons. It's not like, oh, I have too much cash in the bank, I need to figure out what to do with it. I don't know what to do with it. It's generally when people buy. So I usually try not to look at buying and selling too much. But
Yeah.
I totally get why it could influence people's decisions.
And to be fair, I forget what the space program is that Bezos is trying to do or invested in to kind of compete with Elon Musk and SpaceX. But those space adventures are extremely expensive. Like you could spend billions of dollars probably pretty quick. So to that point, I could definitely see him maybe taking some profits and then reinvest in that and his kind of space ambitions or whatever. So
a Blue Origin.
yeah, maybe that's right. I can't remember, to be honest with you.
Yeah, I didn't even never heard that name before. Yeah, but I know he was trying to compete with. There was that company that just landed on the moon.
Yeah, Lunar. Yeah, I saw your video on that. Yeah,
Intuitive.
Or LUNR, I think.
Yeah, LUNR. These companies, it's cool. It's pretty amazing, but they don't really make money. There's no. It's hard to monetize what they do. It's such a long road to seeing return. So as an investment, I think it's terrible, because, and that's why the market, I guess, isn't really too excited about these stocks. But the AI is interesting. But I think like that term, the trend is your friend. Just go with it. As long as it keeps going up, just keep going with it. Keep buying into it. But just don't be too surprised. Because I was telling my friend who made a ton of money on Tesla, he had them pretty early, like in 2000.
Oh, really? Wait, hold on. 2000 what you said?
Like 15, maybe he started getting into them. And he made a ton of money. He got it in at 30, I think, his cost basis. And then when it was up to over 1,000, I know they split, so it's come down. But
yeah, they split a couple times. Yeah,
pre-split, I remember when it hit $1,000 a share, which gave them $1 trillion market cap. I remember that.
Yeah, that was nuts.
They ended up, I think, getting up to, if anybody correct me, I think 1.2 trillion market cap at their peak. But I kept telling him to sell, and he wasn't selling, but it kept going up. So I felt stupid telling him to sell. But it has come down. I mean, it was down to 100 about. But it's just not. It's I don't know. It's not a great industry. It's a hard industry to make money manufacturing cars. Not as hard as airplanes, which seems like airlines never seem to make money over the long term. But car manufacturers generally don't make a lot of money. Like, it's not an industry with a great return. So it's just crazy to see a stock hitting $1 trillion. But it's not that low. I mean, it's still trading. What's its market cap? $600 billion.
Right. Well, during the virus, you remember, like, people were trying to short Tesla, and it was like something like the amount of dollars lost trying to short Tesla was like more than the entire market of the airlines. Like, I forget what the billions were, but it was people that were trying to short Tesla lost tons of money.
Some people lost everything trying to short Tesla.
Yeah.
Michael Burry, he lost billions.
Yeah.
And I'm totally with them. And I didn't short them because it's really about timing for shorting.
Yeah.
You could be right for shorting, but you still lose a ton of money. But when you long a stock, you can be right and you never lose any money. You can lose what you invested, I guess, but you could wait it out. You could wait a decade till the stock goes up. With shorting, you can't wait even a year. You might lose your entire investment.
Right.
So yeah, it's just a timing thing. But
even shorting, doing a true short versus like a put option or something or other option strategies, you can have unlimited risk and get margin called and you know, like when GameStop went up and all that, and you know, craziness, you know.
Yeah, that was a fun time. Did anybody see the Netflix show for GameStop, Dumb Money?
I haven't watched it yet. I probably will at some point, but
it's okay. There was a Netflix which I really enjoyed. It was with Hulk Hogan. Trials of the Free Press. It's really tied into investing. Like, I don't want to give away the plot. It's a real situation, but that's really interesting. His trial was funded by Peter Thiel. And nobody even knew this. Peter Thiel was funding. He's a billionaire. He was one of the. He started PayPal. He actually ousted Elon Musk from PayPal because they merged his company and Elon Musk's company X.com in like 1999. They merged to become PayPal, and he kicked Elon Musk out to become. That was really interesting. I learned a lot about. But yeah. But GameStop, you know, Roaring Kitty, I watched some of his videos. He convinced me. I was like, you know, he makes a lot of sense about GameStop.
Yeah, I'll be honest. I made a lot on the second pop in March, and then I didn't cash out, and I was dumb. I cashed out a tiny portion, but yeah, I got kind of hoodwinked on that. I'll be honest.
I've done that before. You hold, you want to hit the millions, and then you end up losing most of your investment. You could have taken a 50% return. Instead, you took an 80% loss. I don't know if you lost any money, but I've done that before, and I still think about those times.
No, I lost. I should have done like maybe covered calls or either bought put options. I don't know. There's a few different strategies I should have done differently to hedge, you know, because you can hedge. You figure, you know, there's different ways to hedge your risk or whatever. But but like the first pop, I wasn't in it, but I was watching it pre-market, and I remember when it reached, I forget, because now it's pre-split, but at that time I think it was like, I think the top was like $500 and something pre-market. But you just saw the numbers. Like, I never seen anything like it. I was laughing, like, even though I wasn't in the thing at the first, like, that pop right there, I just was laughing hysterically, dude. And I was like, oh my God. It was like the crazy. I've never seen anything that nuts. That was the craziest thing I ever seen in my life. I was like, or one of them at least.
But I thought equally as crazy as that, which I couldn't believe, like, when it went up, but I understood it. Like, I understood it. It was a short squeeze. But what I thought was, when it came down, it came almost not as high, but it wasn't that much lower. I couldn't believe it came all the way back up again. I was like, what's going on? I thought the short squeeze is over.
You want to know my theory of what happened there?
I'd like to know.
Huh?
Yeah, I'd like to know, because
so if you had watched, and I'm going to do pre-split prices because I can't do the math in my head. I just remember what the pre-split prices were.
Yeah.
When GameStop hit 70, okay, before the split, when it hit 70, the options chain had to open up, and then it opened up to, I think the top price was like $800 or something. And so something happens, and I can't explain exactly why and how. Market makers or people that are better well-versed could explain it more. So like that right there would be like, you know, when it hit, I think it was like 528 or something, or 524 pre-market, or, you know, hit around that mark. I know it was above 400, but it was so crazy. It was like pretty nuts. But anyways, when they extended the options chain, whatever the max price was, it does something to the market to sometimes make it go like crazy, you know? So like DWAC was another stock that, like, when they open, you know, it blew up and they opened up the options chain and then it tanked.
Yeah.
Essentially my theory on it is it's like the call options are so expensive, they have to reverse the trade. So if they're a big market, or a big, fund manager, and whether they're losing money or they're making money, people that have call options eventually are going to sell. And I know people will say selling a call option doesn't put, down pressure on a stock, but I'm going to disagree. Okay. So if you're in and you hit the top, you could sell you could either, if you bought a call option, you could sell it, but you could also do covered calls or sell calls to make money on the downside as well. Or you could buy put options for when it goes down. But essentially the options were so profitable that you had to know it was going to go down and go down hard. So put options at that peak, when GameStop was at the peak, put options were extremely cheap, like dirt cheap. So you could have bought a bunch of call or put options. It's risky playing options, but you could have bought a bunch of put options for dirt cheap. It tanked, and then your put options are worth too much money. And so this is a risk to somewhat, in my opinion, to the market makers and stuff. But the put options were worth so much money where you knew it was going to have to go back up because the put options were making too much profits. And so then you saw that second spike there in March. And so I was there for the big tank, the big red ones, held on and then bought more. And then I was there for the second spike, but I was kind of a schmuck and I held on, and I should have, I took a little bit of profit, but I should have definitely played a little bit smarter. And then, that sideways movement, that's like where, you're not making nearly as much money off the volatility. I mean, those are some big swings still after those 2 points, but not like those first two big jump ups,
Oh yeah. Yeah, no, I was
but it was the option chains opening up. They extend every time if you look at it and say you go to bed and the max price or the max, call option is say $500, right? And then they have to extend it to the max call option is 800. When they do that, expect a reversal of that direction because it does something to where, it usually hits the chart pretty hard in the opposite direction, typically, of what I've seen at least.
All right. Yeah. No, that could do options. Yeah, that could lead to lots of volatility.
Yeah. No, options are risky. I'm just saying, if you see, even if you're not trading options, if you want to either buy shares or short it, sometimes just watching the option chain and seeing what the max was, and if they opened it up, it could be a tell sign of if it's going to reverse or something it's going to do.
Yeah. Usually when I look to buy options, calls or puts, it seems like it's so expensive.
Because the volatility's priced in, yeah.
The premium, it almost seems like it's almost never worth it. I guess I have to try to find options before the entire market talks about it. Like when I look at it, it's usually like when everybody else is talking about it.
Right.
So I'm looking at options. I'm like, I do the math, and I'm like, it would be such an extreme situation where I could make a lot of money. Like the stock has to go down like 80% or go up 80% just to. But I was going to buy options on AMC and around here because I remember the first pop, then it came down, and then I remember GameStop came up a lot. So I was going to AMC, but I didn't, of course.
Yeah, a lot of that is AMC's debt, and then the CEO, Dan, can't think of his name right now, Adam, or Dan, can't think of his name. But anyways, the CEO sold a lot of his shares. He told people he was going to sell them, but the CEO, I mean, I own a few AMC shares, nothing too crazy, but I think the CEO of AMC is really shady. I think he screwed a lot of people, and he hoodwinked a lot of people. And there's, I'd say some questionable stuff with that CEO that really made some decisions to hurt the stock price and, didn't do what was best for his investors. He said one thing, he did another thing. And he was somewhat honest, saying he was going to sell shares and he hadn't sold any. But anytime a CEO is going to dump some shares, it usually almost always hurts the stock price. So I won't, this me personally, I won't invest any more money in AMC after, Adam Aaron or whatever, after the shadiness that he did to his investors.
Yeah, I mean, as a company, I don't like AMC. GameStop, I think, is okay, but AMC. It's hard. Movie theaters are a hard industry these days with all the.
I mean, I will say if you look at a longer time frame chart, because I'll look at sometimes longer time frames like monthly, weekly, both charts are almost set up at some point. Maybe we hit another low in the market, and then we're hit a bottom, but both charts almost look like a insane bull flag, in my opinion. It's setting up to where eventually, even though there's been a lot of down pressure, eventually they're probably going to get a spike up. They may not reach the previous all-time highs, but I think both, if you like zoom out from like a monthly or weekly chart, it almost looks like they're both setting up for a bigger move at some point down the road. So there could be some buying opportunities because it's not. I mean, it was expensive before. Now, I'm not saying it's exactly cheap, but it's better than it was for potential to trade. I'm not talking about long term, but
right. When you do options, it's got to be. It can't be too long. 3 months is a long time for options.
Yeah, definitely.
Yeah, but it's a beautiful thing because each option contract you can control 100 shares. So that may sound like a simple concept, but there's some people on here that might not realize that.
Right.
So you could control for like $5,000, you can control like maybe 1,000 shares of a stock, and $5,000 couldn't buy you, that many shares of most stocks. But there's a lot of, because there's a high probability you're going to lose most of your investment, which is the main risk of, because a lot of options expire worthless.
Yeah, no, it's definitely risky. I've lost a good portion of money on stuff that was going to go one way, and so you definitely got to do your research on, and risk what you're willing to lose.
It's kind of gambling in a sense.
It is, yeah,
because you're trying to time it. Like, it's not a pure gamble, but it's much more leaning towards gambling than just regular investing, because you're really trying to time the market. But there's nothing wrong with it. If you have a couple $1,000s, you want to learn about options, but don't sell options, but buy options, because if you sell them, you have a potential unlimited losses. But if you buy calls and puts, you can only lose your premium.
right.
So if you're
unless you have shares that you want to leverage to sell that option, with your a covered call.
But then you just lose your shares, which in theory could be a loss of extreme amount of money if the shares.
Right.
That's how I lost my Meta shares, and I still to this day, because I bought Meta the first day they started trading for $40 a share.
Oh wow!
And it got called away at like nearly 200 a share, so it wasn't like I lost a lot of money, but I was just selling covered calls, so just making money.
Right.
It was up to like 150, 170. This is back in like 2016 maybe. Oh
wow.
So it got called away. It went up too much. If you sell covered calls and the stock goes up too much, then they just take your stock away from you. Right. I mean, not the end of the world. I ended up buying back, and I'm still holding on the stuff I bought back. I think it was at 150 or 160. So I'm up like 250% on that.
Oh, nice.
I'm a long-term investor. Everyone seems to be focused on crypto or AI stocks these days. Would it be good time to start investing in fintech stocks or consumer cyclical companies? Interest rates get cut. No, it's if you want to, like I said, the trend is your friend. So if you want to go with it, just and go all in AI, but just you got to remember there's going to be a crash, because remember the EVs were like that's all anybody talked about for a while, and nobody talks about it anymore, because there's only really all the EV companies like the NIOs, and those companies, probably people lost so much money. Tesla is doing okay. It still hasn't come down, but like if you look, wow, it's down to under 6. I remember people putting money into this company. They're like, oh my God, I'm going to be rich. But
a lot of times when it's pumped up and at like media all the media's talking about it, people on forums are talking about it, that's usually what from my experience, at least, typically when you're about ready to see a reversal in something, after everybody's bought in, people are going to start selling, taking profits, and then you're going to get people stuck holding the bag. But who knows what phase we're in of that cycle? If we're at the middle, if we're at the top. I mean, I'm not saying we're at the top. I don't know, but
even if we're right here with AI, so say you bought it at $30 a share, pretend this is an AI company, and then after 2 months you're already up 100%. You're probably not going to sell. I mean, I don't know how you could predict it, but real fast. I don't know. So it took about a year to get back to where you started. So even if you were up 100% after a few months, and then after a year you're back even, you're probably not going to sell because you're like, I was up 100%. I want to, and most people just keep holding, and then they're down 20%. They don't want to sell at a loss. Then they end up losing 70, 80% of their investment if they hold out.
Who's that you're looking at? Neo? Is that Neo, you said?
Yeah, that's Neo.
Dang. Yeah, I mean, people got hit hard from that one.
Because no matter where you buy, it's even if you bought it down here at 18, because it's just hard to know. Because if you were in NVIDIA, you would have been kicking yourself if you would have sold.
I wouldn't touch that thing with a 10-foot pole, but that's just me, dude. That thing.
Could you imagine if you?
It looks like GameStop, dude. It looks like a GameStop stock.
It's the most. This is the most ridiculous stock ever in the history of stocks. And I'm not just saying that, but the amount of growth, like no stock. I mean, it took like a couple hundred years for a stock to hit $1 trillion market cap. And I remember as a kid in the 90s, when I was in high school, when I first started following stocks, I just remember like looking, all I did was look at the stock price and the market cap. That's all I did when I started. I had no idea what I was doing. And I remember seeing like Exxon was like the largest company at like 400 billion market cap. And I was like, will there ever be a company with 1 trillion? And then a few years ago, it happened. And this company went from 1 trillion to 2 trillion, like within a month. And it took like companies like Microsoft and Apple, like really solid companies, a long time, like probably a decade or two to get from 1 trillion to 2 trillion. And this company did it in a month. It's just
Can you zoom out real quick? Can I see the further, like back to between 2020 and 2022, like that kind of time frame?
Oh, between.
Yeah. Just scroll that way. Yeah. So that first run up right there. Yeah. Perfect. Thank you. All right. So at that very top, and I think it was 2022, Jim Cramer was pumping up NVIDIA saying, yeah, buy. And then it takes a big crash after Jim Cramer was pumping it up. And then at the very bottom right there right there at the very bottom, he was asked if people should buy NVIDIA. He said, no, I would never buy NVIDIA. And then look what happened. So almost if you inversed Cramer, and a lot of people probably know this, but you would have been profitable. If you listened to him, you could have got really taken advantage of. But
really, because I never heard him talk about it. I just was listening to him the past few weeks, and he was saying he's so bullish NVIDIA. He's been bullish for over a decade. He said he named his dog NVIDIA, and I was like, I never heard him say that.
He told people to sell at the bottom. He said, I would sell NVIDIA. I wouldn't be buying it. Meanwhile, him and his company is buying it up when it's cheap, knowing that it's going to go up. This is how I'm sorry, dude, I don't want to do that to your channel, but this is how they do it. They always tell you to buy when they're selling, and then you tell you to sell when they're buying. So they want you to, buy high, sell low. And so then they make money off people and stuff. And because, these are hedge funds with, millions and in some cases, billions of dollars,
Yeah, because I remember when NVIDIA got up, like post-COVID, when it got up to these levels, and I was thinking, I can't believe NVIDIA, they don't even have that much in revenue at this point. I was like, how do they get so high? And then when it came down, I'm like, okay, that makes sense. It's coming back down to reality.
If you know how to read a chart, I knew when Jim Cramer was saying that, he was full of crap on both occasions. When it was at the top and he told people to buy it, I was like, no way I would buy this. This thing's about ready to crash hard. And then when it's at a bottom, I looked at a chart and I was like, oh, this is a good buying opportunity. I wasn't in a position at the time to buy, but I looked at a chart and I knew. I said, this has got to be at least close to a bottom. And Jim Cramer was telling people not to buy. You think about that. So, but if you know how to read a chart, you would have known on your own analysis without someone like that to buy, on your own research and stuff like that. That was like the perfect time to buy, right in that bottom area.
Yeah.
And even if you got it within a month or two of that area, you would have been good. But
I totally didn't see it, and I feel so stupid. Like I totally didn't click on what they did, and I don't know how people got in on this, because I didn't like. This is just the craziest growth I've seen. It's just nuts.
Well, part of that might be subsidies, or I'd have to research it, but part of our Congress might be putting some money towards AI or whatever, NVIDIA, because the chip sector, I don't know, but there's probably someone that's more versed in that would probably know that, because that does happen. That happened with Tesla. Well, Tesla was a little bit different, where some of the other manufacturers and stuff had to buy like some of their bonds and stuff. But yeah, there's a lot of money that went into that NVIDIA for sure.
But it's definitely hype. It's definitely market hype. Because they went from 1 trillion to 2 trillion in like 2 months, which is like, I mean, hardly anybody's ever hit 1 trillion. There's only like maybe 7 companies, so 6 companies that even ever hit 1 trillion. But in like, it's totally market hype. And but I'm not going to say bash NVIDIA. I did a couple of years ago. I said it's extremely overvalued, but they've hit their targets. They've hit their revenue to a point where it's still, I think, overvalued, but it's not as bad as I thought it was. But they just have to continue growing at 100% a year.
Well, it also depends if you're a day trader, swing trader, long-term investment. If it's something you're going to keep for 10, 15, 20 plus years, I mean, if you bought it lower, then you're probably good, even if it goes down. If you're wanting to get in, maybe wait for a better buying opportunity kind of thing. But kind of depends on, what kind of, because a lot of people, I think, forget, that part. If you're going to day trade it or swing trade it or long-term investing, all those are different categories, in my opinion.
But this is like a similar thing when they said this whole internet thing in the 90s was going to be huge, which they were totally right, because the internet is huge. But what companies benefited from that? Not that many are still around from the late 90s to early 2000s that did. Right. There's this company, Google, that's still around. And there's but not many. Like there was AOL and Google were like such Goliaths in the search engine space. AOL I thought was a better bet because they had like the whole chat rooms. They were really, really popular. Like they kind of hit on all levels, and they even acquired like Yahoo, right? And but they fell off. I don't think anybody uses AOL anymore. Google took over.
Yeah, AOL dial-up. You remember the dial-up sounds to connect the internet?
That was great. And you had to pay like $10 a month to just get 15 hours out of AOL.
Yeah.
In the beginning, I was there from the very beginning. I was in high school. I remember using.
Yeah, me too.
So exciting. You wait like a minute for a page to load.
Yeah.
Like, oh my God, I could find anything on this internet. But Google's getting a lot of slack. They're like, Google and Apple stock hasn't moved in 6 months. It's like flat. Let's see. So March. So the August to March, in 7 months, it's flat. You don't see this with other, like Meta's up like 200% or like 100% in 7 months, and Netflix is up like 60% in the past 6-7 months. But Apple and Google are getting a lot of heat for not innovating, not embracing AI.
Yeah, interesting.
I've been bearish Apple for a couple of years now.
Oh, really?
Apple's.
Why is that like a thesis or based off the chart, or what are you thinking?
I just think. I think it's an amazing company, but I think they're kind of a one-trick pony. Like 70% of their revenue is the iPhone. And I just like things change too much. And I remember when people were using computers, how it was so innovative, and like I can't believe, like in the 90s and early 2000s, computers are only for companies. Like people didn't have computers in the home.
Right.
If you did, it didn't really do much. Then people were using computers to like do homework on, do work on. Everybody had a computer. But now then it changed to the iPhone, where the iPhone is kind of like people are using to. Things change too much, so they have to keep up, and I don't think they're kind of keeping up with the trends as much as. So I'll show you guys.
Well, plus they just canceled that. They were doing an EV vehicle, didn't they? Just cancel it or something like that, or?
Yeah, they spent so many billions of dollars trying to break into a market that has a low return. Because automobile manufacturing is a very tough market. It's a huge market because everybody needs a car. So there's demand. Every single city in the world, pretty much, there's demand. It's just a tough market to make money. But I'll show you guys the Fab 7 or Magnificent 7. See, like this is just in the past year. So Netflix is up 100%, which I bought for my wife's account. And I'm extremely bullish on Meta, so I'm up. I have a lot of Meta. Meta's up 50%. Google, maybe I'm thinking the past 6 months. The past 6 months, Google's flat, Apple's down 5%, Meta's up 65%, Netflix up 37%. I don't even want, and NVIDIA's gonna be hard to see everything when we throw it in. Bulldog, thank you. I appreciate the sticker. Okay. So NVIDIA's up just like Meta, only in 6 months, 69%. I'm missing one company, right? Amazon. So as much as Apple has helped the stock market because it was leading the way, Apple and Microsoft, with a flat Apple, and the market is still up a ton, breaking levels, all-time high. So that gives me more faith in the U.S. economy when Apple and Google are down or flat, and the market is still breaking records.
Don't you think, or if say we don't hit a recession, say if my thesis is wrong on the LIBOR to SOFR transition, and something like that don't happen, don't you think like mid cap and small cap needs to catch up to this kind of bull run with some of this AI stuff going on, or what do you think on that?
I was thinking about like just selling out everything and going into the Russell 500, Russell 1000, whatever it's called. I think small caps, there's so much upside. But the reason these 7 companies, it's really these 5. Not even Netflix isn't even really part of it. I would say it's mainly like NVIDIA, Meta, and Microsoft. Those 3 companies are like 25% of the gains the past 6 months.
Right. Yeah, they're holding up the market.
It's just because they have such a high base. Like when you start at $1 trillion and go up 70%, it's just such a huge. Because even if you were 100 billion, you went up 100%. It's still not even. It doesn't move the needle. But when you have $1 trillion, and you go like NVIDIA went from 1 trillion to 2 trillion, which was nuts. But yeah, I mean, NVIDIA is only up 70% in 6 months. I thought they'd be up more. Thanks, Bulldog. Yeah. So if you guys want to invest in these huge companies, Google and Apple haven't really moved this past 6 months. So either they're going to continue that trend, or there could be some upside growth with those.
Well, I also think it depends on what they do with the rates. If they hold them, or let's say if they end up lowering them, that's where I think it could benefit mid cap and small cap if they lower the rates down, because with lower rates, you can price in longer years of growth typically. So if it's something that's been flatlined or hasn't had a lot of movement, but it's maybe kind of stable, you might see a good jump just, from, lower rates. But we'll see what the Fed does on that.
Yeah, that's interesting. So in the past 2 years, Google is up only 4%, which is crazy if you think about it. People were saying Google has the most upside potential out of any company. I remember.
Yeah, well, I'm not saying betting on small caps is good right now, but it depends on what happens with the rates, because it used to be, or at like during the virus and stuff, like small caps, mid cap, the tech companies, they all did really good when rates were low. You know what I mean? Because typically, at least from my research, what I've understood is that the lower the rate is, the longer out you can go for future growth. You know what I mean? So some of these companies are pricing in 10, 15 years of growth or 20 years of growth, like where their prices are right now. And if the rates are lower, then that makes it easier to price that in. If the rates are higher, typically it's hard for the stock to price in that many years of growth, So when I look at it like that, you're right. There's probably gonna be a lot of small mom and pop shops that are probably going to bust. But there could be some good opportunities if you do some research, you find someone that you think's like going to be around for whatever reason. And, if they look like, I mean, it's just, to me, it's the way I look at the market. Is it cheap or expensive? Is NVIDIA cheap or expensive right now? I don't think it's cheap, unless you're looking 15, 20 years down the road. So there's probably gonna be a better buying opportunity if you're wanting to get long on it. And none of this is financial advice, but if you're holding it, then hold, but or whatever you want to do. But I'm just saying that there's times to just look at it and do your own research, I guess.
But that's the beauty of putting into an index. When you put into the S&P 500, these are 500 companies, active companies, and if anybody goes bankrupt or defaults, they just get replaced. I mean, it does bring the index down a little bit, but when you invest in individual stocks, if they go bankrupt or go down, that's it. You're kind of toast. So it's just so much safer to.
Well, and like Tesla's a good company, but like a couple years ago, or it was like a year, no, maybe 2 years ago, losing my time frame, but my wife's dad had a friend who's at a Christmas party, and he's a financial advisor, and he was telling my wife's dad to buy a Tesla, and like he was going to put 10 grand in Tesla or something. I'm like, well, let me look at the chart, because I can read charts and stuff. And I was like, I would wait. I was like, I think there's going to be a better buying opportunity. I wouldn't get long right now. So, and then Tesla went down quite a bit or whatever. But Bulldog asked what my number one pick is right now. I'm kind of being patient, guys. AMD is a good one to run with NVIDIA typically, but sometimes you might be able to get some momentum, swing trades on AMD. If AMD hasn't moved as much as NVIDIA, sometimes AMD will follow. That's correct. But I'm going to wait to see what the Fed does. Just me personally, guys. None of this is financial advice, but because if I'm correct on what I think, which is I don't think Fed is going to lower rates, I think they're going to keep raising rates. I think they're going to break the system. We're going to see, especially with all these commercial loans coming due and some of those contracts and stuff like that. So I'm just being patient, So that's why I said I don't have any, and I'm not shorting anything either, guys. So or buying put options, I might at some point, but right now I'm just going to be patient, and try to be like a sniper, like a ninja, not FOMO anything up or down, and just kind of see what happens. I mean, NVIDIA went up a bunch, came down pretty good, like was a couple days, and then shot back right up and went to all-time highs. So, so people thought it was probably going to crash right there, and they got hoodwinked. So,
yeah, when it came down, you always think, okay, I'm going to wait because I think it's going to keep come down a little more. I'm going to wait till it hits this level, and then when it hits that level, a lot of times you're like, okay, I think it's and we end up waiting, and then it goes back up before we buy in. Same
I think
thing when
it's
you
going to go down. I mean, I could pull up my charts or whatever, and I could tell you where I think Nvidia is going to go if I'm correct on it. But I think Nvidia is coming way down. I think we're going to hit that support level when it kind of flatlined out. You
it
know,
has to.
somewhere. I'd say 500 to 600. Well, no, I think below 600. I'd have to look at it again. But yeah, I think it's coming down. And so for me, like my favorite stocks are going to be ones that I want to own long term. So whether it's Tesla, Nvidia, when some of this, if some of the stuff comes down, I'm just going to look for good buying opportunities of stuff. But I'm looking for stuff I want to hold long term, like, 10, 15 years. So, but that's why I'm being patient right now.
Yeah. But it was similar with Tesla, although Tesla didn't have much as extreme growth as Nvidia, but we knew it was going to come down. But I don't think Nvidia is going to come down to like a low stock. It'll look like probably similar to Tesla, where it shoots way up, but it could take a long time to come down. It could take years. And
True,
even if you
yeah.
got Tesla at say 100, and even if you waited through the ups and downs, you still doubled your investment. As long as you didn't buy, north of like 250, you're in good shape.
Right, yeah.
It's still a good company. It's not like you're buying like an AMC for 400 and
right. Well, and I mean, do you think Tesla's going to be around 5 or 10 years from now? That's the way I would look at that. And then the growth that Tesla had, look at the run up. I mean, it has to consolidate, it's got to, get to a point where is it cheap or expensive? And like, could it come down some more to find some more support? Yeah. But I think long term, I think Tesla's going to be around. And I think, whatever your longer term plan is on that, if you can get a good price on some stuff, yeah, that's, yeah, I'm more in the long term. I mean, I'll swing trade some stuff, sometimes day trade, but yeah, it's, so, if that's where I like to look at is more what are you going to want to hold for long-term portfolio? You can buy some opportunities in there. I think over time stocks almost always go up, long-term picture. You go back 20, 50 years, unless it's a Blockbuster or a Sears or Kmart or whatever, like all those, companies traditionally do well. So just kind of depends on if you think it's a company you think is going to, do well, Like I'm not buying crypto right now or Bitcoin, but I think even Bitcoin in long term is probably going to go up. So higher than where it's at right now, or it's all-time highs.
Yeah. Yeah. It's kind of like with the .com companies, only a handful are still around, but those companies are really successful. So Bitcoin will always be around.
Right.
There's like thousands of cryptos that won't be around, but Bitcoin, I think, will always probably be around. But there'll be a shakeout. A lot of these AI companies will probably not be around, like Supermicro. I don't know. I'm not too familiar with them, but I know the stock's gone up like 50,000% in the past 2 years, something crazy like that. So,
oh geez, that's insane.
In just 2 years, it went from, I can't even see in this chart. It went from 40 to 900.
Oh my
in 2 years.
That's nuts.
It's so hard to see. Just in January of this year, at the beginning, oh no, that's 2023. So yeah, in 2 years, it went from 80 to 900.
Yeah, but that's what I'm saying. Would you say that's cheap or expensive? I mean,
that's not normal. Like that just doesn't. That growth is not normal. So there has to be a pullback, but generally the pullback isn't that far down, and then there's support, and it comes back up. So the thing is, you just don't know where it's going to go. So that's why you got to hold long term for good companies.
Yeah.
Yeah. But yes, good stream. Thanks a lot, Hardcore Raider, for your your opinion and all that information.
Thanks for having me on and letting me kind of ramble. I like to kind of talk about some of that stuff sometimes. So
anytime. I think a lot of people like the stream. A lot of good comments. And yeah, I hope to see you on next stream. I got to get ready. I'm working out a little bit. So thanks everybody for the comments, and I'll talk to you guys later.
All right. Thank you. Keep up the good work, man.
Yep. See ya. Okay. Bye.
Later.